all of the enthusiasm is out, and it's exactly the opposite. The question is, can it continue? Is that going to be the leadership next year? What I find interesting about all of the outlooks, they all say, yes, this is going to be the leadership next year.
Absolutely.
It will continue.
What did Gretzky say? Skate to where the puck is going. This market is trying to skate 6 months out to where the puck is going, and they think it means a weaker economy, but not a recession, some rate cuts, maybe, and a bond market that's supportive of an equity view, which means equities carry on rallying. It's that good. It's that simple.
Goldilocks that can continue forever.
Unless you're JP Morgan, because JP Morgan is saying 4,200 on the S&P 500. That's quite a call, Bramo, after being wrong 2 years running, to come out and say 4,200 on the S&P 500, going completely against the grain.
They're going against the grain with the equity market call. They're not going against the grain as much when it comes to what's behind that.
No, the logic stacks up.
The logic is interesting to me, and this is sort of how you can have an economic call and be right and get the market completely wrong. And we have seen that again and again. This time, people are coming at this saying, yes, the consumer's going to slow, you're going to see a real pullback in spending. Does that mean losses for equities, or does that mean continued gains, because that means that rates are lower, and that means that going forward, we're going to have a lower pace growth that's more sustainable? Stock
market bulls love this bond market, so let's talk about this bond market. 2-year, 10-year, 30-year. Your 2-year has come down from 525, 526 in October to 465.54. Your 10-year has come down from north of 5% to 429.55, even with, Lisa, a 4 basis point move on the day. And yesterday was rather like the day before. Selective hearing. Certain Fed officials, Barkin of Richmond, suggesting maybe we might have to do more. Others, Bostic of Atlanta, suggesting maybe we're done and there's more disinflation in the pipeline. I would suggest we continue to listen to the ones that encourage this bond market move and speak to the consensus view and ignore those that are going against the grain.
And partly this is because of the disinflation that we're going to see from the PCE. It's partly because this is what people want to hear, so they will hear this. What do you feel more confident in, though, John? And to me, I've been kind of surprised that the 10-year has participated as quickly as the 2-year. I mean, to me, this has been the biggest surprise. 2-year, I get. You know, if inflation's coming in more aggressively, okay, this makes sense. Longer term, does it make sense if the issuance picture is the same? The Bank of Japan is signaling that they're going to relax even further yield curve control. There still is a host of concerns about who the buyers will be in a higher yield environment.
I'll try and make it simple. 2 years of policy call. Further out along the curve, way too many variables. Think about the logic for the move to 5%. That was a month ago. A month ago, and here we are, we've got guests on this program saying, yeah, there's reason to drop into the 3s, when we had people on this program talking about reasons to go up towards the 6s. 1 month later, has that much changed in a month?
Well, the price has changed, so we can change our view as well. There is this issue, though, what causes it to change back? And that's what I'm going to be looking for, to understand whether it's the auctions, whether it's something else that's longer term about higher inflation for a bit longer than people expected.
Let's finish on the commodity market. So most people got October wrong, and then got November wrong as well. So October, we were down by 10.76% on crude. November, we're down around about 3%, even with this move. So WTI in the 70s. What a surprise after what we saw take place in early October.
People thought that you'd see supply constraints due to the Hamas-Israel war, due to what could have been an expanding conflict. Now we're worried about demand falling off a cliff. We're talking about oil prices continuing to go down. And now with OPEC Plus meeting virtually from COP28, there's this real question about whether they're going to cut further and whether they can get Angola and Nigeria on board.
I'm sorry. OPEC Plus meeting in COP28.
That's essentially what it is. I find that hilarious.
Let's move on. Under surveillance this morning, Henry Kissinger, the former Secretary of State who played a key role in Soviet and China relationships during the 1970s, has died. Kissinger spoke to Bloomberg earlier this year about the difference between American political debate now and the 1970s.
In the present period, the debate had shifted to extremes in which there is an extreme theory of America first, and which is applied on both sides, but in such a way that it focuses too much on American interests and not on global interests.
Henry Kissinger was 100. Secretary of State Antony Blinken arriving in Tel Aviv as Israel and Hamas agree to extend their truce by another day. The short extension allowing for the release of more hostages. Blinken saying the pause in fighting has been successful and they want it to continue. And this government, Lisa, is under pressure to make sure it does.
Yes, this is the problem, that as we just heard from Norman Rule, the objective is not close to being accomplished. And both sides have not shifted in their view. So fundamentally, as you and I have talked about extensively, nothing has changed. There just is an incentive for a pause. So what does it look like afterwards? When Norma Rule was talking about a more selective, a more surgical type of incursion in Gaza, what does that look like? How much can the U.S. get on board with that? How much pressure is there? How long does this last? These are some of the questions that people are asking.
I don't know how the Biden administration balances contradictory views. And they're contradictory views for the following reason. One, you want to stand shoulder to shoulder with Israel, who has one single aim: to destroy Hamas. And we know, because of the nature of this war, destroying Hamas will mean a loss of civilian life. And then at the same time, you want to make a statement that says we need to limit the loss of civilian life. Those two things are almost incompatible because of the very nature of the way this war is playing out on the ground in Gaza. So, Lisa, the pressure will continue to build to extend the ceasefire and extend the ceasefire. But as we know, at some point, there's going to be a re-engagement. The war will restart and the truce will end. And we know what's happening within Biden's party. The pressure is building and building and building, and the clock is ticking towards next year. And this is becoming a big, big election issue, and you see it in poll after poll.
And this is a reason why a lot of people think when it does resume, when the fighting does resume, it's going to look very different. And it's not going to be the same kind of big, large-scale bombing.
So we finish on a lighter story.
Please.
An expletive-laden rant. Elon Musk and the advertiser boycott stemming from his endorsement of an anti-Semitic post could kill X, formerly known as Twitter. Musk apologized for the endorsement, but speaking at the New York Times Deal Book Conference said this: what it's going to do is going to kill the company, and the whole world will know the advertisers killed the company. Go F yourself. Companies including Apple and Disney have been distancing themselves from the platform in the wake of the endorsement. Bob Iger, Elon Musk is there.
Hi, Bob.
On the stage. Hi, Bob. Hi, Bob. And towards the end of the exchange, and I think a lot of people have only watched those 2 minutes where it finishes with hi, Bob. Towards the end of the exchange, he finishes on how much good Tesla has done for the world and talks about, and I think alluded to, the virtue signaling of corporate America, who in Elon Musk's mind seems to be more interested in the perception of doing good than actually doing good. Because people love what Tesla's achieved. But the problem is, Lisa, for a lot of people, that's not the man they want running the company. And Elon Musk pushing back aggressively against that. He gets it and pushed back aggressively against it towards the end of those comments.
I'm not sure that people are going to be talking about that in part because of how he was messaging some of the things that he put out there. And I am curious what exactly he means, John, when he says that the world is watching. And if you kill X by withdrawing your advertising dollars, everyone will know and we're going to document it. What does that mean? They're going to sue them for withdrawing their advertising dollars? I mean, you can say what you want to say. He could be right theoretically in certain aspects of what he said. But at the end of the day, what feels good might not actually have legs in the legal world.
We'll talk more about this a little bit later this morning. Let's turn to the global economy. Janet Henry, Chief Global Economist at HSBC, joins us now. Janet, don't worry, we're not going to talk about that. We've parked it. We're going to talk about the global economy and Eurozone inflation. Janet, downside surprise. We've seen similar stories emerge in the United States. Do you have confidence that the next move from this ECB is a rate cut and that move might be just around the corner?
I'm pretty confident that the next move will be downwards from the ECB, but I suspect it won't be quite as soon as the markets are now pricing in. Looking at it, it seems to be there's a 50-50 chance now of a rate cut as soon as March. I think there'll be a sigh of reassurance across the ECB that they don't have to continue to tighten policy. But remember, it was only in the last few days that there was talk of bringing forward the halt to reinvestment of the PEP program. So I think, yes, the next move is down, but more likely it still will not be in the first half of 2024. We'll have to wait a little bit longer.
Do you think, Janet, that's because inflation's not going to come down enough, or do you think it's just because of the conditioning of ECB members from getting it so wrong in terms of how quickly inflation accelerated on the way up?
I think inflation is still too high. I mean, that's a fantastic print. Everyone's over the moon that we got a 2.4% print on inflation from the Eurozone, and a downside surprise in core inflation as well. But core inflation is still running at 3.5%. And also, we know that November is the trough. Headline inflation is probably, just given the base effects, going to start rising again from December. We are optimistic that core inflation does continue likely to edge somewhat lower over the course of the next few months, but it will still be too high, and ECB members are still watching those wage numbers. And actually, the latest print on negotiated wages, so that kind of stickiness that we often see in the Eurozone, is likely to keep certain areas of core inflation somewhat elevated. And, it's fair to say that for the last few years, remember, inflation's been above target for over 2.5 years. They know which way the risks are still skewed. If they need to, they can cut interest rates aggressively. We don't expect that. So the reaction function matters. But for now, inflation is still too high, even if moving in the right direction.
Janet, how do you understand the fact that the economic trajectory seems to be being downgraded pretty significantly as we get incoming data, even as the labor market continues to seem solid? Is the labor market not the same signal, not the same indicator that it used to be?
Well, it depends which country we're talking about. There's a lot of uncertainty about the UK labour market data. And obviously, even policymakers are grappling with that at the moment. But what we've seen in Europe, and we had further data out of Germany this morning, was a rise in unemployment. And Germany is in more of a traditional recession. The economy has been contracting for some time. But in the US, obviously, the labor market is still very, very tight. But actually, the US has seen some downside surprises on inflation as well. So I think the markets react still to the activity data. Anything weak on the labour market, particularly with regard to the US, they bring forward their expectations for rate cuts. Likewise for the Bank of England, where we got a very weak service sector PMI. It was, the Bank of England will have to cut a bit too swiftly. So I think it is, the markets are struggling with is the inflation and the activity data. At the moment, the activity data aren't reviving, even if they're not deteriorating as rapidly as some expect. But it has been the good inflation news, albeit just for a month or two.
Janet, I think sometimes we talk about these central banks as if they're machines, rule-based, and you plug in some data and it spits out a call. But these are human beings conditioned by their experience, and their recent experience was to be very, very wrong on inflation. Janet, do you think that almost guarantees, because of what they've been conditioned by, that they're going to be very, very late when they have to move the other way?
Not so much that they will necessarily be late. I think you have to decide what would be a policy error on behalf of central banks. A year ago, people were saying, is the Fed going to make a policy error? And they meant, is the Fed going to cause a recession? Actually, for a central bank that has an inflation mandate, a policy error would be that they tighten policy so much that inflation falls too much. Inflation falls below their target. And remember, that was a lot of the battle for the last decade when they were slavishly trying to hit the 2% target and were keeping policy very, very loose because it was at 1.5%, trying to force it a little bit higher. So I think it is, yes, all of their reaction function is conditioned by the recent past, but also longer periods of history. But ultimately, even for central banks that have got a dual mandate, the Fed's getting towards balancing the risk between activity and inflation, but more explicit inflation targeters, it is absolutely about the inflation side.
Janet, appreciate the update. Janet Henry there of HSBC. Coming up, much more on Elon Musk and X.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
Technology is really changing the way we live. We all know that, but we get kind of jaded about it. Already, AI as it exists create for profitability for companies, even in tough times. Overall, it says stock prices to move higher as technology feeds all 11 sectors.
Stolfus there, John Stolfus of Oppenheimer Asset Management. If there was a roundtable, a panel that I would love right now, it would be Stolfus on the one side and a team over at JP Morgan in the investment bank at the other. Stolfus and the like talking about the prospect of pushing 5K on the S&P 500. JP talking about 4,200 on the S&P. That's quite a spread.
How much does this really hinge on tech? And I say that because a lot of people are saying the rest of the market can stay basically in purgatory as long as tech continues its trajectory upward to the moon, right? And this has been the story all year. If you start to get some sort of reckoning where we understand where we are in the cycle, then it can continue that much more. You know, again, it's almost, how much is this an AI discussion without being an AI discussion?
Would you like an autos discussion?
I would like that.
I think we should have that right now. I want to look at two names, GM and Ford. GM yesterday, big move higher. Big buyback, stock buyback, $10 billion worth. Hike to the dividend, all the good stuff. Stock absolutely flying. GM up by 0.75% this morning. Ford out with this, reinstating his forecast. Lisa, full year adjusted EBIT, 10 billion to 10.5 billion. The number that jumps out for me now, the labor packed cost. These numbers are huge.
Yes.
Expected to cost 8.8 billion. I think GM was around 9, so certainly in line. But the difference is, the cost effect to be about $900 a vehicle by 2028. That's a stark contrast with what we heard from GM. That's a few $100s more.
That basically the implication here is they're either going to have to lose it in margins or they're going to be charging more for their vehicles. GM was saying they could offset it and that they had been prepared for it. So here's the question, right? Is this going to eliminate some of their competitiveness when they're facing off with vehicle manufacturers in China and elsewhere that are coming up with cheaper options? How much is the price point increasingly a question? And does it come out of margins or does it come with pushing the consumer just a little bit more?
They've put a number on the lost profits during the strikes.
Yep.
$1.7 billion. 1.7. That's a pretty punchy number, isn't it?
Which is the reason why I actually find it interesting that they reiterated their full year forecast, right? It highlights that they would have otherwise beat pretty significantly. Next year is really the question. If we do get a softening in the economy and they do have higher charges from existing labor contracts, again, where does it come from if they're struggling to move those cars and they can't finance it with cheap money because that's off the table at this point?
A reinstated forecast. Seeing full year adjusted EBIT 10 billion to 10.5 billion. We'll catch up with the CFO in just a moment. Earlier on in the program, we were talking about an expletive-laden rant from Elon Musk, talking about X and advertisers, and then talking about Tesla. Let's get to Alex Webb over in London, who joins us now, who watched all of that exchange. Alex, let's talk about it. And I want to talk about one specific angle. I want to talk about the Walt Disney Company. When Elon Musk looks into the audience and says, "Hi, Bob." Alex, if you're at the Walt Disney Company right now, and you're running, I don't know, corporate relations, PR, whatever, what are you saying to Bob Iger right now about what the next move should be?
Don't say anything. I think that, you do not want to find yourself actively embroiled in this hullabaloo around anti-Semitism, which is, frankly, appears to be the reason why Disney and others have pulled their advertising from the platform. The thing that's kind of wild about this is, the users of Twitter, of X, are not its customers. The advertisers are the customers. Now, can you imagine any other company in the world? Like, imagine if he had said that about people who buy Teslas. If he'd said to Teslas, use this turn of phrase, which I will not repeat, but you can find it in our story at least. If you said that to Tesla buyers, he just never would. So it's kind of wild that he's therefore saying it about his customers on his social media platform.
But there was a veiled threat, Alex, basically saying you will kill our platform and we will track it, we will document it. And with the implication there was going to be some accountability. Do you have any understanding of what that looks like?
Well, I mean, you know, Twitter and X it's never been the key platform for almost any advertiser, right? It's a nice to have. It's a second tier in the sort of pyramid of social media platforms of it's good for brand awareness, particularly among a particular cachet, a particular coterie of users, sort of media types, people are actively engaged in the news. That audience has maybe dissipated a little bit in recent months, therefore perhaps not as appealing to get to those people anyway. It isn't the sort of thing that Facebook, Meta, Instagram, TikTok as well increasingly provides, and certainly Google provides, which is hyper-targeted advertising to people who are really likely to spend money on your products. That has never really been what Twitter and X offer. So the fact that they're pulling back from it, the numbers they're spending on this platform don't appear to be massive anyway. The pullback, you know, it doesn't seem like it's going to damage these companies. If they pulling their business from the platform ultimately leads to its bankruptcy, I mean, that's not really, it's hard to see why that's got repercussions for them. This is not seen as a public service. It's not as though you're pulling money from, you know, public infrastructure or something. This is a private company, so it's a very strange threat to wield.
What about for Tesla? Does this have implications for Tesla, given that Elon Musk is an increasingly polarizing figure?
We have seen some reporting around the fringes about appetite for Tesla, for their products, maybe taking a little bit of a hit because of some of their CEO and controlling shareholders' behaviors. You're not necessarily seeing massive impact on the company's numbers as a consequence. You know, you see plenty of examples of companies where, you know, perhaps perception of leadership or perception of the company as a whole isn't brilliant, and yet it still does exceptionally good numbers. So I think the bigger concern for Musk at this stage is his investors in X, in Twitter, right? And whether those people start to ask questions behind the scenes which could affect the way he runs the company.
That takes us to the banks. Elisa had a conversation earlier this year at the World Economic Forum in Davos with Morgan Stanley.
Yes, James.
And you asked directly about that, didn't you?
Are you going to end up owning Twitter?
What did he say?
No, we are not going to end up owning Twitter. Well, if you're not going to end up owning it, what's the potential ramification for you?
We should find that sound from earlier this year. I remember that exchange, that conversation. He referred to Elon Musk as a brilliant man. In many ways, he is a brilliant man. But it just raised the question, Alex, will the banks end up owning this platform?
I mean, it is actually, I was having a similar thought this morning. We need to think through actually what the ramifications of a Twitter bankruptcy might be. Don't forget, the banks have a slightly different game here because there are other companies that are controlled by Elon Musk, not least SpaceX, that at some stage could be looking to IPO, right? And there are plenty of banks who are going to be wanting a piece of that business. Therefore, they do not want to be getting on the wrong side of Elon Musk. He is someone who we know, you know, can appear to bear a grudge at times. So it's a tricky task for them. There is a huge amount of inherent value in Twitter, irrespective of whether it gets driven into the ground through a combination of advertisers pulling their ads and perhaps some behavior of the people at the top of the company. Namely, its user base. And like, people will pay to acquire users. And I'm sure there's a long list of tech companies that would queue up to try to acquire Twitter and embed it into their own network of products for, you know, pennies on the dollar of what Musk paid for it, you know, a little over a year ago. So there would always be appetite for this business from an M&A perspective. The banks, I do not envy their position because they, you know, clearly see a huge amount of potential in business from the broader Elon Musk universe.
Alex Webb, thank you, sir. Out of London on the latest. I'd love James Gorman's thoughts this morning on this, wouldn't you?
Well, his thoughts on the record or his thoughts off the record?
Off the record, obviously.
Yes, because on the record, he would say he still is a brilliant man. He is unconventional in the way that he goes around things. We're assessing the value of this company. I imagine that off air, his expletives might be somewhat similar to the expletives that we heard last night.
Well, given what Alex said, there is some business to be had elsewhere, right?
Yeah.
There might be an IPO just around the corner.
Okay, sure, with Starlink, et cetera. So maybe this is basically a token to get some of that business. That said, they can't necessarily be particularly happy. Linda Yaccarino, she came out and she just sort of sat stone-faced listening. She put out on Twitter her perspective, which I think is interesting. Here's my perspective when it comes to advertising. X is standing at a unique and amazing intersection of free speech and Main Street, and the X community is powerful and is here to welcome you. To our partners who believe in our meaningful work, thank you. That's what she came up with.
That's a tough seat. That's what that is.
That is a tough seat.
Let's turn to Ford. The latest on Ford just a moment ago, reinstating their guidance, a range of 10 billion to 10.5 billion. You'll remember they suspended their guidance back in July. That was previously 11 billion to 12. So a slight trim there, but ultimately, Lisa, widely expected. Ford is up in a pre-market by 2%.
It's interesting that they're lowering their profit guidance because we've been asking, which would you rather, lower margins or having to charge more to consumers? That equation was different, say, 6 to 12 months ago. Now are we going to start to see them take the hit in the margins in order to move volume and gain a competitive advantage against some of what we're seeing, in particular out of Asia?
Well, just on margins, higher labor costs at about $900 to the cost of each car, and on margin, shaving them by as much as 70 basis points.
Yeah.
We'll be catching up with the CFO of Ford, John Lawler, in about 20 minutes' time. From New York City this morning, coming up next on Your Market, Michael Schall of Market Field Asset Management. That conversation just around the corner. Equity futures positive here by 0.2%. From New York, this is Bloomberg.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television. Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
There's a lot of participation going on right now.
It could be a more volatile beginning into the year, and then it should calm down.
We're going to see a slower economy, but I think that companies continue to view labor as a scarce resource.
Our base case is still continued slowdown on the labor market side in the U.S.
We got to get a soft landing, not only in inflation, but also the labor market.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
The best month of the year for the U.S. stock market. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Farrow. Your equity market on the S&P this morning up just a touch by 0.2% on a month. Up big time, by almost 9%, Bramo, through the month of November.
It didn't feel like it. That's all I can say.
Well, the bond market move, wow.
Yeah, the bond
market. Down more than
market.
60 basis points on a 10-year.
So the bond market move was a wow, and yet equities rallied into weaker than expected economic data, right? So this is really the question that we've been asking all morning. Is this inconsistent in some capacity? Does this have to break down? Or is this basically what we're going to see going forward, that the bond market's going to rule the world and we're all just living in it?
Well, it's ruling the world this month. Let's see if it rules the world into next year. Lisa, how polarizing is the conversation on Wall Street? On the one hand, we're talking about the fastest growth we've seen in some 2 years in the U.S. economy, north of 5% for the third quarter. On the other, guest after guest after guest after guest having a conversation about recession a few quarters away.
Basically saying that maybe we're just not seeing the weakness. And that's sort of what Beige Book really fed into, that anecdotally there is a weakening, particularly in the labor market, and you are seeing a weakening in good spending. But I take your point. If you annualize this, it's near as 9% GDP on a nominal level for the year for the United States economy. This doesn't scream recession, which is the reason why people are saying Goldilocks. We don't get inflation. It's back to transitory without anyone saying transitory. We were just 1 year delayed, and we're back to it for 2024.
At the surface, things look pretty decent.
Yeah.
Growth is okay. Jobless claims are still near 200K. You dig a little deeper. You go to Friday, record holiday shopping. You go to Sunday, busiest day ever for U.S. airports. You get beneath the surface. Buy now, pay later, absolutely exploding. Credit card delinquencies are going up. That's problematic. You can tell the consumer's reaching. You look at consumer confidence, sure, improving just a little bit. Gasoline prices are lower, I get that. But ultimately, the consumers hasn't felt good about this economy. Hasn't felt good about it at all. And TK, I think, has absolutely nailed it. Regardless of what's happened with wages, on average, this is about the cumulative inflation over the last 3 years. And it hurts.
It hurts significantly when you take a look at average prices rising by more than 20% in those 3 years. So given that, does sentiment start to indicate that they're going to do something about that and reduce spending? Or does sentiment continue to diverge with what they actually do? Going forward, a lot of people are looking to next week's labor market report as the key indicator. That if we do see a real weakening on that front, then we can say that a lot of the strength is backward looking. It is bringing forward some of the spending to deal with discounts, et cetera, and that we can maybe think about something else. But that's a big if, because we haven't seen that falling off.
Jobless claims, the appetizer for that. We'll get those jobless claims a little bit later this morning. Bramo's going to go through the Canada for you in just a second. I want to go through the scores. Your equity market on the S&P 500 positive here by 0.2%. Month to date, the S&P is flying, the NASDAQ too. We're looking at double-digit gains on the NASDAQ 100 for the month of November. For yields, up this morning, down aggressively over the last 4 weeks. 429.36 on a 10-year. Up 4 basis points this morning. Only a month ago, we were talking about 5%, Lisa, on a 10-year yield.
It's a mind-boggling whipsaw, and it's come with pretty aggressive disinflation, which certainly makes sense, at least on the front end of the yield curve. Today, we get personal income and spending as well as core PCE. Very curious to see whether we see the same bigger than expected disinflation in the U.S., similar to what we saw from Europe earlier this morning. And of course, the jobless claims very much in focus with the labor market and questions there. Today, OPEC Plus is meeting virtually. And the reason why they're meeting virtually is because a lot of the delegates are in COP28 talking about removing the dependency on fossil fuels. The irony is not lost. At the same time, the discussion will be about demand coming off and potentially jawboning some of the members to effectuate greater cuts to production. This has been one of the big mysteries, John, honestly. Why have oil prices gone down so much at a time we're talking about geopolitics and we're talking about north of 5% GDP growth in the third quarter?
We're not going to get the oil embargo we might have got in the 70s. The U.S. is less dependent on crude coming out of the Middle East. I saw a stat, I think, in Barron's over the weekend, 75% of crude exports coming out of places like the Saudi, like UAE, are going to Asia now. Asia has a very different view on this conflict. And I think given that, given the fact that we've saw aggressive diplomacy to make sure this war didn't spread, if you woke up on the morning of October 8th, the day after that tragic terrorist attack, there was a belief this could spread. that quickly deteriorated, and crude followed suit, trading lower.
And it shows how much the playbook has changed and how difficult it is to get it right in an environment that's shifting very quickly. The Fed speakers have actually been way more interesting this week than I previously had thought. Mea culpa. New York Fed President John Williams is planning to speak at 9:15 a.m. Does he lean into the discussion that we heard earlier this week from Chris Waller in particular, saying that all they need to see is inflation get roughly down to target for them to start aggressively cutting rates? It doesn't make sense to have as restrictive of a level, given how quickly you are seeing prices stabilize.
It's quite an interesting week. We'll get Chairman Powell tomorrow, so look out for that as well. You hear from the Federal Reserve Chairman in the next 24 hours. With us around the table, Michael Shao, CEO of Market Field Asset Management, joins us here in New York. Morning, Michael.
Good morning.
Let's talk about JP Morgan just briefly. 4,200 price target they've got on the S&P. I wonder if you agree with this. They say current valuation is rich. The market is assuming a near perfect landing with inflation cooling without a significant impact to demand and pricing power. You on the same page as them?
I never like S&P targets, but the basic idea that everything's exactly where you want it, it doesn't kind of stay that way. I mean, I think either the economy is still okay and strengthening, in which case I don't think the 10-year is staying at 425, or we're in this pre-recession period and we're going to have a much, much weaker economy in 6 months' time, which apparently people want. And that's not really compatible with the S&P going to 5,000.
When you say apparently it's what people want, what do you mean by that?
I mean, I think there's a lot of sort of wishful thinking. I sort of feel that we've gone through this sort of 2-year period and we're exactly where we were. The market's where it was in November 2021. In November 2021, we were all convinced that the Fed could stay at nearly zero for almost as long as it wanted to. And sort of now we're sort of wishing the Fed to be able to cut rates aggressively without any adverse impact on the economy taking place at the same time. And that's an unlikely scenario. We could be in this pre-recession period. Things could get much worse from here. The Fed could be cutting rates, but that's not going to be great for corporate profitability.
So how confident are you? How much conviction are you to lean against the sort of Goldilocks narrative?
I think it's going to all be about rates. And I think that you've gone through this sort of incredible whipsaw where the long end of the curve was a one-way short bet. Now it's a one-way long bet. I think we're going to end up with the 10-year back in that 4.50 to 5% range. And I think the economy's okay. I mean, I don't think we're pre-recession. I don't yet see any clear evidence of any portion of the economy really getting into trouble. The only thing I could really point to is commercial real estate, particularly multifamily, where you do have the signs of a real slowdown in activity. But I don't think that's big enough to really represent what the single-family home market did in 2007. It doesn't look the same yet.
If it's all about rates, and you see rates staying at about 4.50 to 5% for the 10-year, does that mean that stocks are going to suffer, considering that they've gained on the heels of a pretty big bond market rally?
What it means is that you're going to need to see much better corporate earnings than people expect if the S&P is going to make progress. I don't think that let's say the 10-year at 4.75 is devastating for the S&P. But I think you'd need to grow into current valuations in that situation. You're not going to have the same fuel that you've had over the last 4 to 5 weeks, really propelling everything back up.
Who does have pricing power right now? Walmart talking about deflation. We'll talk about the auto sector a little bit later. They've been cutting prices. Who's got pricing power?
Well, it's not really deflation. I don't think the U.S. consumers, really tapped out yet. I think that you're going to get, you don't need as much pricing power with input costs coming down where they are. But I think if we went back into a world where commodity prices were rising and things were tight, demand was tightening, I think you would see that people still have pricing power. I think that you have changed the inflation psychology semi-permanently during COVID. It's really, the world post-COVID, post-pandemic is not the same as the world pre.
So Goldman says the hard part is over. The disinflationary tailwinds are in the pipeline. Growth can continue. Sounds like you might think the hard part is still in front of us.
I think the hard part's always in front of you. I mean, the nature of economies is they are dynamic, and the nature of economic data is that it's constantly exaggerating moves in one direction and then exaggerating back in the other. And in a sense, the worst news we can have is that we had a near perfect set of data in October, which has all been released over the last 4 to 5 weeks. My guess is that the November data will be more complicated. Either we'll see much weaker growth than we're looking for. We'll see higher inflation numbers than we're looking for. But you don't tend to get everything lining up exactly where you want it for 2 or 3 months in a row. Even in the you look back in retrospect and say, well, my God, that was so obvious that this was happening. In real time, the data doesn't actually help you in the way that it has over the last few weeks.
I love that Goldman said the hard part is over. George Saravillos over at Deutsche Bank says the easy part is over. Or in other words, bonds up equals equities up should now be ending. This will better for the dollar too. Michael, is that sort of your sense too? That let's say we don't get what you expect, which is a lift to bond yields going forward, and yields do continue to go down. Are we going to see a divergence where this is bad news for equities on some level?
Yeah, because I think what takes yields lower, I mean, what does it take to get the 10-year to fall back below 4%? I think it would be clear signs that the economy is rolling over, the Fed has gone too far.
2 more days, Michael.
2 more days, yes. Two, but it'd have to be big days.
I agree. Carry on, I'm joking.
2 big days. I think that it would require much clearer evidence of a problem in the U.S. economy and something for the Fed to address.
You sound exhausted, and I don't mean it in sort of like a day-to-day kind of way, but it's sort of tiring to see the same narratives kind of coming back to the future 2 years from now. And this doesn't feel like there's a lot of conviction in how to push against what you see as maybe a little over-enthusiasm for Goldilocks. Is that right?
I think you spend 2 years and you end up back at the same place. It's somewhat tiresome. But I think markets and economies are dynamic, and the thing about this business is when it looks really easy, it's going to get hard, and when it looks really hard, probably something will change.
It only looks easy looking back. I always say that nothing about this is easy. It never is. And there's a phrase that I absolutely despise: the easy money's been made. It's just never easy, is it?
No, but sometimes it's easier than others.
True. So. It's all relative. Michael, thank you, sir. Michael Shaw there of Market Field Asset Management. I think we're all exhausted just by the narrative back and forth. Yeah. Keep going back to James Athey, Aberdeen. Just narrative table tennis, ping pong. It's been like the year so far, hasn't it? Hard 100%. Landing, soft landing, no landing. Soft landing Nirvana. Neil Dutta, thank you. We'll catch up with Neil a little bit later. If you're just joining us, catching up with us now, welcome to the program. Your equity market positive here by 0.2%. A lot to talk about in the auto sector. We're going to do just that. We'll catch up with the Ford CFO, John Lawler, in just a moment. They've reinstated their guidance. So earnings now, the range 10 billion to 10.5 billion. Previous range, before they had to take it out because of this big spat with UAW, that was suspended. It was 11 to 12 billion. So that's come down just a touch. The stock is up by 1%. Notably absent this morning is a conversation about a $10 billion stock buyback, which is what we talked about with GM. Perhaps a different approach this morning, Lisa, from Ford.
It is a different approach, and we'll get more of a sense of just why that might be and their approach in just a few minutes. To me, I find it interesting, this question of how much is going to come out of margins and how much is going to come in the form of higher costs for the vehicles. You asked about pricing power to Michael Showell, and I think it's an interesting question. Is there a difference between different sectors in terms of how much pricing power there is, and how much does this really rely on the overseas competition and what the prices are there?
Who does have pricing power right now?
I would say that certain luxury names have pricing power.
Okay.
I would say that there are refrigerator makers. No, I'm kidding. I think that, there are certain areas that have pricing power. Think of Apple. How many discounted iPhones do you see? Not very many.
I know. I'm still struggling with mine. Still struggling.
You haven't gotten a new one yet?
I'm holding on.
Good luck with that.
I sort of tap into the website to think about doing something about it, but no, I refuse to do it. If you're deliberately slowing down my battery, it
feels pretty terrible when you go in, you drop a couple $1,000s, and you come out and they're cute little boxes.
Which iPhone are you buying? A couple of $1,000s?
No, I'm not saying for that. For all of the suite of products for the upgrades. No, come on.
John Lawler, CFO of Ford, coming up next from New York City this morning. Good morning.
Business Week Radio. Live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
From an EV perspective, we have confidence in the portfolio we have. We're a bit disappointed this year that we were constrained by the automation to build modules. We think we're going to see a strong adoption for our products, and as the charging infrastructure continues to be more robust, we think that's going to drive adoption, as well as having affordable EVs.
That was Mary Barra there, the General Motors chair and CEO. In many ways, that conversation didn't really matter. What did was just a number, $10 billion buyback. Biggest buyback ever at GM. And you have to consider that before that was announced, the market cap was $40 billion. 10 billion, maybe to Apple or something, you know, drop in the ocean, nothing. Right. To GM, that's huge. That's a monster buyback after agreeing to a huge labor contract only a few weeks previously.
There are a couple of questions embedded in why now, and I think you got to them with Mary Barra in your conversation yesterday. One of them is, does this suggest there isn't a better place to invest right now, that returning capital to shareholders rather than focusing on growing sales and growing revenues in other areas might be a more attractive proposition? The second thing is, going forward, how difficult is it going to be to have pricing power given the competition that you're seeing overseas?
Well, going forward, we've got some new outlooks. The latest from Ford this morning, a new range for 2023 adjusted earnings before interest, 10 billion to 10.5 billion. The previous range before suspending guidance, 11 to 12. We've got a lot to talk about. We can do that now with John Lawler, Ford CFO. Good morning, John.
Good morning.
Let's talk about it. Where is it? Where's my $10 billion buyback? Why a different approach from you and the team?
Well, we have a great plan in our Ford Plus plan, and we're focused on investing in growth and profitability, and through that, rewarding our shareholders with a higher price, plus also paying out 40 to 50% of our free cash flow in dividends. And so we're investing in the business. We have three great segments that are growth segments. Ford Pro, our commercial business, margins in the mid-teens for us. That's very high in our industry. Profits are going to almost double this year, more than double this year. And we have a great opportunity with the moats we have to drive significant profitability.
Costs are going up as well. So let's talk about the labor contract. $900 to the cost of each car off the back of that UAW contract. Now, just for our audience, because you're aware of these figures already, GM, who we spoke to yesterday, are at $575. I'm still trying to sit here and work out, how do we get from $575 at GM and $900 to the cost of each car at Ford? What is that about?
Well, when you look at it, we're $500 to start in 2024, and that grows over time as wages increase. The biggest increase in this contract is gross wage increase. It's significant, over 25%. And then our footprint in the U.S. is bigger than General Motors, but the rest of that, I'm not exactly sure why their number is that much lower than ours. That's something that we'd have to unpack with them. We know what we've done with this contract. We know what the start point is. It's 60 to 70 basis points on our income statement basis. And now what we need to do is we need to work on driving productivity and efficiencies and reducing the labor hours, the hours it takes to build a vehicle, and reducing that cost. And that's what we're going to be focused on going forward.
So it's going to be cost reductions rather than trying to raise prices for the end consumer. Is that right?
Well, now, you have to think about pricing differently in our industry because all segments aren't the same. There's different pricing power across the segments. That's why we feel that what we did in segmenting the business and having the transparency around that's important. If you look at the commercial business in Pro, we believe there's still pent-up demand and pricing power there. However, in Blue, in the more of the retail consumer segment, you're going to see prices come down. We've been consistent talking about that. Back in 13.4% of disposable income to buy a vehicle. Went up to 15.7 in 2022. It's down to 14.5% roughly now. We see that coming back to 13.4% as you move through 2024.
When you talk about lower price points, I think about some of the Chinese car manufacturers and the production much more cheaply of electric vehicles in particular that are really making a competitive advantage. How do you compete with them, especially given the labor contracts and some of the other working operating costs that you're dealing with?
Yeah, it's a good point, and that's something that we're very focused on. Again, the segmentation, each segment is different. We've seen prices come down in the electric segment much quicker than we expected, and the reason for that is that we're moving out of the early adopters who are willing to pay for higher prices. Early majority customers aren't. They're not willing to pay that premium. So we're seeing those come down, and we expect them to equalize with gas prices. So it's all going to be about cost and efficiency, capital efficiency, et cetera. We have to get more competitive on cost, and that's what we're focused on in our second generation and third generation vehicles.
What is happening with demand in the EVs? What is happening? Is this real pushback that changes your approach?
I think what it is it's the adoption rate. It's flatter than what we had expected. The increase isn't as great. 50% up this year from a sales standpoint. So they're coming. It's going to be part of the industry. Eventually, we'll get to those higher growth rates. So we have to adjust our capital investment. We have to adjust our approach in the near term.
That sounds like a change in execution, not strategy.
Absolutely. It is a change in execution, not strategy.
So let's talk about the numbers. You've pushed out 12 billion in EV-related investments. Should we expect to see a little bit more of that going on?
Depends on the customer and the adoption rate and how that pushes out. If the adoption rate starts to grow faster, we'll increase our capital investments.
Well, let's go through the guide. I've got 2 points.
Sure.
I want to see if these are still up to date. So you did expect half the sales to be electric vehicles by 2030. Still the case?
No, we think it's going to be less than that, given where the
How much
consumer
less
adoption.
will it be, John?
We haven't put a number on that yet. We're still looking at what that rate will be. I think we'll know more as we go through next year.
Is it the same for margins on those EVs as well? Do you have to reassess how big those margins will be?
Yeah, I think as the industry adjusts, you have to look at that. But we're targeting, we've set up our business structure, and we think the right target is around the 8% or high single digits.
You said that you're very focused on trying to be competitive in the EV space on price. Is that, and we asked about margin compression, you're basically saying we're going to see as we go on what the competitive landscape looks like. But how do you plan to reduce costs? Is it going to be with job cuts? Is it going to be with more automation?
So yes, absolutely automation. That is going to be a key part of what we do. Now, when you look at this contract, it's also important to understand for us where the battery plants are. And the battery plants aren't part of the contract. And so that's important for vertical integration. And when you're talking about electric vehicles, battery and design is really important. And the efficiency of that battery and getting the smallest battery possible in. So that second generation design is going to be critical from a cost standpoint. And then overall for us as a company, we have work to do on our cost and quality. And we're focused on that. We've made significant progress over the last few years. We restructured international operations. We moved out of autonomous vehicles and pulled capital investment out of that, focused on L2. We have the best driving system out there in Blue Cruise, according to Consumer Reports. So we're making the adjustments as we go.
When you talk about automation, and you know, there's a question around job cuts and how much this will reduce the overall number of workers who will have to be employed to make cars. Is that what you foresee, that there is going to be a fewer team of professionals that are creating vehicles in, say, 5 years than today at the Ford plants?
So in certain areas there may be, in other areas we see growth. The key is driving efficiency and productivity. So more coming out per unit of labor. Doesn't necessarily mean you take the labor out, you get more productivity. That's what we need to drive towards.
Let's finish on a delicate question. I ask this question a lot, and I'd like to ask it directly of you. Is a Ford F-150 Lightning truck, which weighs about 6,000 pounds, really good for the environment? Because I struggle with the association between these heavy electrified trucks and climate change. What is the relationship? Are we kind of kidding ourselves here?
I don't think so. I think that there's two things about the electric truck. One, it's moving into electric is important for the overall environment. That's true. But number two, you also have to think about the consumer and what that truck can do. It fills a niche that hadn't been out there. There are certain individuals that just will not drive an internal combustion vehicle. They never had access to a vehicle in the utility like a pickup truck. They now have that. Plus, for our commercial customers, it's a tool. It's a generator. They use it on the job site to power. Now you don't have gas generators sitting out there. It's electric. It's coming from the vehicle itself. So it is a good step forward in the environmental push and reducing the CO2 footprint.
That conversation will continue. It's good to hear from you. Great to get an update on the numbers as well. Thank you, John. Appreciate it. John Lauder there, the Ford CFO. I have to say, Lisa, and some things that John can't really say, given that he's over at Ford, but confusing to hear that from Ford and then think back to what we heard from GM yesterday. Are we seeing more transparency around costs from one company maybe than from the other?
Well, we will explore that going forward. There's going to be a real question here. Yes, because this is going to be key to margins, key to pricing power, key to figuring out the competitive landscape. It is a big concern. In other words, how much of a hit does that mean to each particular
It's pretty
car?
curious. Ford are out there saying, like, the number's right up here, and GM's saying, yeah, it's down here. Okay. Kelsey Barrow's coming up shortly. JP Morgan Asset Management. John, thank you. It's good to see you. Appreciate it. Futures on the S&P 500 positive by 0.25%. It yields up by 4 basis points, 430. The surprise of the month, though, yields down aggressively through November. More on the month that was and the month to come, coming up next.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
We are closing out, wrapping up the best month of the year on the equity market, on the S&P 500, pushing 8.5% up month to date. Massive. On the NASDAQ 100, best month going back to July 2022. First month of gains, incidentally, since July 2023. Equities up this morning by 1/3% on the NASDAQ, up on the S&P 500 by 1/4%. The Russell up by 0.1%. The regional bank stocks absolutely flying this month as well. You can say thank you to the bond market. 2-year, 10-year, 30-year shaping up as follows. The 2 years come down from north of 5% to 465. The 10 years come down from north of 5%, Lisa, to a break of 430. Even with a 4 basis point move this morning, higher, we're back to 429.55.
So now do we get confidence that we're seeing stability or just another whipsaw move that sets up the next leg of a narrative, right? I mean, this is sort of the key question here. How much can we get confidence that, yes, we've seen the peak in benchmark rates, but that is going to lead to an ongoing disinflation back to 2%? That is a straight line that will lead to a very low 10-year benchmark yield as well.
You don't sound exhausted by this at all.
Well, it's like, come on. I mean, it's just frustrating because it feels like we're trying to justify something in a different way depending on where it is at a certain time. Hard to understand whether this is positioning, whether this is... I mean, I don't really get what is actually driving the volatility. And so it's frustrating a little bit to try to explain it.
We should clip the comments from October 19th. Everyone justifying why yields are above 5% and play them out now and ask them what's changed in a month. What's changed in a month apart from the price action?
I think that the one thing that has changed is that you have seen disinflation, true disinflation, and the data's come in less than expected, and you've seen it not just in the U.S., but also globally. You've seen it in Europe, and we saw that again this morning. That does shift the narrative. Now the question is how much weakness comes with it, right? And we did see greater weakness than expected in Europe. Do we continue to see that in the U.S.? And how long is this tenuous Goldilocks, this sort of soft landing narrative, how long is that really in play?
You talked about Europe, big downside surprise on CPI this morning. Let's talk about what it means for the euro. The euro has been stronger this month, much stronger this month against the weaker US dollar. In fact, before today, heading towards the best month for the euro and worse for the dollar for the year so far. We're back to about 109.21. Got some euro weakness out there this morning. That data just introducing the conversation we're having on this side of the Atlantic, on that side of the Atlantic, which is rate cut chat to go into 2024.
So are they going to have, and you put this really well, is there going to be a conditioning of getting it so wrong with inflation on the way up that they're going to be late to the game to cut? And we heard a bit of pushback to that earlier. But now there's a question, Janet Henry saying that that's not necessarily the case because it's not a policy error to over-tighten because they're at least going to get inflation under control. But there's a question here around whether the weakness in the economy is going to force their hand more aggressively at the beginning of next year.
I just think we're talking about human beings and not machines. And human beings are conditioned by their experience, and they were conditioned by what happened 2 years ago in a massive way. I think almost embarrassed by it. Let's face it, almost embarrassed by it. You're on the FOMC, you went around for months saying one thing and something else happened. They're going to be very nervous about making the next move.
The key litmus test to me is whether they use the word transitory ever again. If they use the word transitory, they're not embarrassed and they're not conditioned.
I agree with that. That's a good test.
I think that that's a good test.
They haven't been humbled at all.
No.
If they start saying, we were right, it just took longer.
But, I mean, that kind of is what some people are saying, though, so just throwing that out there.
We were right, it just took longer. Yeah, okay. Let's get you the latest stories this morning. Under surveillance this morning, Henry Kissinger, the former Secretary of State who defined American foreign policy during the 1970s, has died. Kissinger is best known for his strategies to end the Vietnam War, open U.S. relations with China, and bring about the détente with the Soviet Union. He was 100 years old. He was also, Lisa, a highly controversial figure.
Especially because he was someone who thought that idealism was out of place in foreign policy, and he was behind a lot of policies that were very protested and very controversial. Interesting to see how some of his philosophies have made their way through the decades and still exist today.
Let's turn to our next story. Israel and Hamas extending their truce for another day, just minutes before it was set to expire. Hamas releasing 10 more hostages and Israel releasing 30 Palestinian prisoners. Secretary of State Antony Blinken in Israel for another round of shuttle diplomacy. Blinken is expected to make stops in the West Bank and the UAE to round out the week. The pressure for that truce to continue, Lisa, every single day builds.
Especially given the fact that Israel continues to reiterate the fact that it wants to eradicate Hamas from Gaza and from the Palestinian people, and you still have the discussion of the Hamas having in its charter that it would like to eradicate Israel and the existence of a Jewish state. So nothing has fundamentally changed. That said, the pressure to bring home hostages is very great, and the pressure to get humanitarian aid into Gaza so that people have enough to eat and so that they have fuel to power their stoves is also very great. So that is bringing them to the table, although it's getting a lot more difficult. it was a last-minute decision to get this ceasefire to continue for another day.
It was fragile, but you'd have to say encouraged just a couple of days ago when we had accusations on either side that that framework for a temporary truce had been violated, and yet that truce held. I'm not sure how encouraged we should be by that, but encouraged nevertheless.
Exactly, but it does highlight the fact that it's getting longer and longer to come to some sort of agreement and the parameters of it, and there are different rumors coming out. It gives you a sense we might be reaching something of the end of this.
Economic data about an hour away, so let's go through some of it for you. Bloomberg Economics expecting a downturn in personal income and spending. The core PCE deflator, the Fed's preferred inflation gauge, also expected to ease with volatility in today's jobless claims thanks to the Thanksgiving holiday. Fed President Bostic Barkin offering opposing views on the path forward. Bostic saying disinflation is likely to continue. Barkin leaving the door open to further rate hikes. The weight on the former and not the latter in the bond market yesterday.
Yes, although honestly, it didn't really move the needle either way because it's basically what they both have been saying for a long time.
For months, hasn't changed.
For months, right. So I think that's the reason why Chris Waller had more sort of an impact on markets. That said, to your point, nobody was listening to anything other than something that would lean into ongoing disinflation and lower rates ahead.
A selective validation, I think, of pre-existing biases, which seems to always be the way in financial markets. You cherry pick what backs up your thoughts already. Kelsey Perro joins us now, fixed income portfolio manager at JP Morgan Asset Management. Kelsey, good morning to you.
Good morning.
The world's moving towards you. Lower bond yields, maybe a slow economy in our future. How are you thinking about fixed income now?
So you're right, yields have moved lower. What we've had is the situation where the narrative can take you much further than what's actually happening in terms of reality. And so we looked at the move higher in yields in September and October, getting to 5% on the 10-year, and we did think that that was just a bit too far in terms of a move, and that we would look back and view this as honestly a great buying opportunity. We've had a positive view on fixed income this year. Yields have moved back down, and that's essentially brought us back to where we were before the September FOMC meeting. So what I'm really focused on right now continues to be the inflation data. So the inflation data, you know, what do we benchmark ourselves against? It's coming down, it's still above the Fed's target, so you have people on both sides saying we haven't done enough, but maybe we have. I look at what they projected in September, and September was a fairly hawkish meeting for them. They were projecting inflation of 3.7% on core PCE. Today's number, if it comes in on consensus at 8:30, will be down to 3.5% on the year-over-year rate, and will be down to 2.6% on the 6-month run rate. So bottom line, inflation is coming down faster than they expected. We think that the Fed's last rate hike was July. We've had that call for quite a while now. We're sticking to that call. And that makes the moves for yields asymmetric. We can move a little bit higher here for sure. I mean, there's a lot of volatility on every given day. But on the other hand, we can move a lot lower if next year we're looking at rate cuts.
You said the narrative can take you much further than the reality. Does that mean that we're in a trader's market?
So I do think that the technicals and the positioning are very important. You need to understand not just what's going on, but what is the sentiment around what's going on. And you had a couple things that were really fueling that bearish sentiment in October. One of them was the fact that you had a blockbuster GDP report and there was uncertainty about what was going to come next, right? We've now at least gotten to the point where we feel comfortable that we're not going to see another 5.2% on real GDP and 9% on nominal GDP. Atlanta Fed tracking has come out. We're normalizing back to around 2%. So we can feel comfortable with that. I think the other thing that you're not hearing any words about anymore is the deficit. Right? The auctions. Lisa, I know you love watching the auctions. They've been mixed, right? You've had some weak ones, you've had some poor ones. In fact, you had that 5 basis point tail on the 30-year auction on November 9th. That ended up being a great entry point into the bond market. And so, you know, sometimes the market fixates on something. Ultimately, we think it's going to be about the fundamentals. Again, what's our view on inflation? What's our view on the Fed? Ultimately, it's not about if people will buy treasuries, it's at what price do they think it's fair. And if inflation's coming down and the Fed is done,
can I jump in?
The price is fair.
Why isn't the deficit part of the fundamentals?
I mean, I think it is part of the fundamentals in terms of the growth and inflation outlook. But here's the thing. The deficit was wider than expected this year, but inflation came down. When you're a country that can print their own currency and they have their own reserve currency, it's not really about default risk. We're not worried about the Treasury defaulting, right? The risk is inflation if you print too much money. We are not seeing inflation. That's because the increase in the deficit this year was because of two factors. One, higher interest costs, but more importantly, lower tax revenue. We're not talking about fiscal stimulus here. We're talking about an economy that was normalizing, revenues that were falling, and then a government that has to fund more because the Fed's stepping out of the way.
It strikes me that you said that the moves now are asymmetric when it comes to the bond market. It makes sense to me on the short end, because if the Fed is done raising rates, sure, I can imagine that that's the case. For the long end, though, there just are so many variables, as John was mentioning earlier, whether it's the deficit or whether it's the fact that the Fed cutting rates sooner leads to perhaps higher inflation over the longer period of time. How much less conviction do you have over your longer-term bond yield call on the 10-year?
So there's multiple parts to that question. One, the first thing that comes to mind is that we are moving into a regime where we should be seeing the curve steepen. So the part of the curve that we should see the most rally, the most move lower if the Fed is cutting rates is going to be that front end. So I would agree the asymmetry around yields is more compelling in the front end than that is in the long end. And I do think that structurally longer term, we are exiting a period of financial repression. And so we are probably at a point, and this is a good thing for bond investors. You know, we're not dealing with negative real yields anymore. We're not dealing with 30% of the global bond index having negative yields. This is ultimately a good thing, higher real yields, but it does mean that we're not necessarily looking at 50 basis points on the 10-year next time we're in a recession, which is what we saw during COVID.
It's what Lisa complained about for 10 years in every single column.
Yes.
The world of negative rates.
It's true. 100%. I stand by it.
I think everyone does. It was ridiculous. I hope we don't go there. Honestly, what was absurd about that period is we all knew it was absurd. It was like one of those bubbles that people would come on and sort of like rationalize and justify. It's one of those things where we all knew it was absurd, but it was pinned there, placed there by policy. Policy was deliberately anchoring it. And that was what was totally absurd and original about that moment.
The biggest surprise for me is that we heard all these people saying the world was going to fall when you didn't have zero rates. And the fact that it hasn't continues to be one of the biggest surprises that we haven't seen, the complete demolition of balance sheets that were really grown up and that were really raised in zero rate policies.
How many people came on this show and said the long and variable lags would be 30 years long? Hardly anyone did. No one did.
No one did.
And now it's like, yeah, they're longer, much longer. Cassie, good to see you. Cassie Barrow of JP Morgan Asset Management. If you are just joining us, welcome to the program. The scores look like this on the S&P. We are positive by 0.3%. Yields are a little bit higher by 4 basis points, 429.16 on a 10-year, which is quite a turnaround, Lisa, from the start of the month.
And it really raises this question to Kelsey's good point, which is how much is the trading moving so much faster than anything fundamental? The narrative is shifting so quickly and people are getting on board. Again, the technicals underpinning this. It raises this question, especially if you've got the likes of Bill Ackman coming out and making these bold rate calls. I mean, what is the hedge fund activity or the levered bets that are behind some of these moves?
It's the psychology of investing. It's always the same. It never changes. You get to 5% and people are like, sell, sell. You go back to 430 and they're like, oh, quickly, buy, buy. Yeah. It's the same in the equity market.
Yeah, although you do wonder if things are moving faster than they have before, just in terms of the narrative shifts. What is the saying or something that the markets are the only place where you buy something when it's full price and you sell it when it's on sale?
Oh, yeah, totally. Totally. I totally agree with that statement.
That's a wrap.
It's like anything else, right? It's like the sales are on, let's go.
Yeah.
And now in markets, it's like, no.
What do they know?
Oh, my, no. Coming up next hour, Neil Dutz of Renaissance Macro, why he thinks it's soft landing nirvana for this equity market. That conversation just 60 minutes away.
So let's go inside the boardroom. Let's suppose you win a proxy fight and/or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with a plan.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
He's
story.
there to kind of upside.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
How to strike that balance between ultimate values and what reality imposes on you. And reality is never quite adequate, but ultimate values are too absolute because they demand a degree of imposition on others. How to strike that balance is maybe given to us as our insoluble problem.
That was former Secretary Henry Kissinger speaking to Bloomberg editor-in-chief John Micklethwait earlier this year. Kissinger, the former U.S. Secretary of State who defined American policy in the 1970s, has died aged 100. I'm pleased to say that joining us now is John Micklethwait, the Bloomberg editor-in-chief, joining us from London. John, good morning to you, sir, and great to catch up as always. Let's talk about the legacy of a polarizing figure, a man who you knew for the best part of 3-4 decades. What is your takeaway on that?
I think he was a giant. I mean, obviously not a giant physically. He was quite a small man, but he was a giant in the sense that it's very difficult to think of anybody else. I was just thinking as I walked through the streets of London this morning, the possible exception of the Queen. I don't think there's anyone who had been part of public life for as long as Henry Kissinger, had met as many people and had, in his case, obviously more controversially the Queen, but had such a dramatic effect on it. I think he was someone very obviously in terms of legacy who changed the world through the bringing China back into some kind of unity with the West and bringing China in from the cold. I think that was a huge deal. You look at détente, all the different things like that. And yes, there were very public and very obvious costs to that, but he was a man of many, many parts. And I think it wasn't just the things he did, it was the breadth of his interest. At the end, he was consumed by AI, but this was a man who was quite a formidable student of history, and that's how he first emerged. And he had a personal life story, which I think kind of captured the century, beginning as someone persecuted, driven out of Germany, arriving in America, coming to serve in the Battle of the Bulge as a still incredibly young man. He saw things by the age of 24, 25 that very few people have seen who are currently leaders of the world.
John, in the 4 decades that you knew him, how did his worldview evolve, especially with some of the shifts that were going on globally?
I think he did change his views, but his basic attitude, and that somewhat convoluted quote that you began with, I think is very true of the way that he saw the world, that there were a set of values, but then there was also reality, and the two conflicted continually. And so I think particularly when he was in office, there was a lot of trying to compromise in terms of what he was trying to achieve with the realities there, and sometimes those were spectacularly bloody. That's why people will bring up things like Chile and Cambodia and places like that. But his underlying sense about the direction in which he wanted to go, I think, never really changed. And he continually also, I mean, in some ways, psychologically interesting, his desire to be relevant, his desire to still be part of the debate. You know, a man who's age 90-something discovers AI, but thinks that that is something you should look at through the lens of Metternich, through the lens of balance of power, and what that can do to the human condition and what that could do in terms of war. Most obviously, the idea of computers fighting each other terrified him, but also that basic idea about what it meant to be human if you had machines that began to think of human. That went right the way back to the political philosophy that initially grabbed him. So yes, I think the reason why he's interesting is partly the life story, coming, you know, both in the sense of a child whose odds of survival were extremely small, ending up as one of the most powerful people in the world, and that desperate and rather ingenious ability to stay relevant long after he stopped being Secretary of State, long after he stopped being National Security Advisor. But also this sense of having something sort of bigger about the world. You know, Kissinger was never someone who ran away from large issues to do with philosophy, large issues to do with science. Any of those things he sort of sucked in. So he was a complex, sometimes a very intriguing man. But he was, to that extent, I think he was one of the most influential people of the time I've been a journalist.
We've mentioned how polarizing he was in several occasions, and you talk about how he was guided by right and wrong and less concerned with the method of getting there. Come under a lot of criticism from the bombing campaigns, as you mentioned, in Vietnam, in Cambodia, with Pinochet in Chile, also with respect to how he really directed policy toward Russia. How much of his philosophy is consistent in strains today of U.S. foreign policy?
I think that an interesting question is that if you look at American foreign policy over the past 30, 40 years, and there were, at different times it was run by people who were extreme critics of Kissinger. The neoconservatives hated the idea of realpolitik. Bill Clinton liked the idea of a more kind of worthy foreign policy, so did Barack Obama. You have to ask yourself the question, would America be stronger if Kissinger had run it? I suspect it might have been. Would the world be more peaceful? I think possibly it might have been as well. I think he always took the long view. And you look at the issue of America and China, the one which sort of dominated a lot of the questions of the past 10 years. What Kissinger repeatedly did was he went back to the issue about great nations have kind of interests, and you have to find ways to accommodate that. So yes, by all means, bring up the issues that divide you, but then try and work out what is possible within the parameters of the interests of those nations. And the reason why he had that, I think, was partly to do with history, the people he studied, people like Metternich, Talleyrand, those were his heroes. They dealt with similarly bloody wars and the aftermath of it. And there was also, I think, a little bit of personal history in that. If you come from the background he did, of one being persecuted, being on the run, narrowly escaping first to London and then to New York, and seeing unimaginable terror, I think in a strange way, you are always looking for some kind of attempt to reconcile these things, to try and bring a little bit of order to the chaos. Obviously, at different times, he got that wrong. But I think that was the underlying philosophy he lived by.
John, you touched on this. There was something deeply unique about how we, the media, treated him, and other countries as well. China would entertain a visit only recently in ways that they wouldn't even entertain for some officials from this White House, from this administration. John, what do you think that was about? That was deeply unique from my perspective, looking at that situation. I can't think of anyone else quite like that. What was behind it?
No, I think it was two different reasons. Number one was the things that Henry Kissinger knew. The fact that in China there is a veneration for old age, which isn't always true of the media, for instance. But in his particular case, there was that. So he had history. You know, he had sat there opposite Mao. He'd sat there opposite Deng. He knew the people who the Chinese talked about, and so there was something big about him that they understood, and they saw him as someone who understood their problems, even if and would criticize them in private. On the other hand, I think being honest, I think another big problem, another reason why he stood out was because there really weren't very many other people like him. If you go to Beijing, you meet an enormous number of people who follow the intricacies of American politics in great detail, the number of Americans who really know and understand China is much, much smaller. And so I think he was both in that role because of his own qualities, but also, you might say, because of the lack of qualities of other people.
Hey, John, appreciate your time this morning. Really do. John Micklethwaite there of Bloomberg, our editor-in-chief, on the legacy of a deeply polarizing figure, Lisa.
Yeah, and just how his diplomatic efforts and role continued far after he left office into a very different era.
More coverage still to come on Bloomberg TV and on Bloomberg Radio, included on this market. Turning to the economy in about 35 minutes' time, you will get some jobs data, jobless claims, kind of the appetizer before the payrolls report next Friday. Claims recently were ticking higher, then all of a sudden, right before Thanksgiving, 209. Anyone who looks at a long-term chart of jobless claims, 209, exceptionally low on a historical basis. And Lisa, once again, speaking to a consumer that's holding on.
It's confusing to me. There are a couple of different markets that I don't really have a full clarity on. One is the housing market and one is the labor market, because we've been hearing about job hoarding. We've been hearing about how this is going to be a job-full recession, that people are going to stay employed, but maybe it'll be harder to get hired, which is kind of the suggestion that we got from the Beige Book. Unclear. History does have some merit as well here.
Steve Weidig of Citi Global Wealth is going to join us around the table on financial markets. Also need to catch up with AMH and Marie down in Washington, D.C. on the latest in Washington, and also an OPEC Plus meeting, which was set to be in person last week, now virtual, with the Saudis pushing for, guess what? Production cuts, because crude right now is in the 70s. Live from New York City this morning, good morning.
World of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lines.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Bloomberg UK, your your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Volatility is still higher than equity volatility. I think equity volatility is priced for soft landing.
The market is volatile right now because nobody really knows what to do or what to expect.
We still do favor the growth side of the equation. We still think that there is value in growth.
Right now, the long-term view is still cautious.
I think we'll be at new record highs for the S&P 500 early next year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Farrow. Closing out the month of November, wrapping things up with some choice quotes from some great guests. I'm thinking of the likes of Jack Caffrey at JP Morgan. What a year November's been. I'm thinking of Neil Dutt of Renmac, who's going to join us this hour. Neil saying it was soft landing nirvana for the equity market, and wow, wasn't it? This equity market month to date on the S&P 500 up 8.5%, and we've got double-digit gains on the Nasdaq 100 for the month of November.
It has felt like a year because the narrative shift brings us right back to where we were not so long ago, and it feels like a year of narratives that were just packed into 1 month. How much do we see this sticking versus just the latest phase in table tennis, or ping pong, as Jordan Rochester called it? This really is going to be the key question heading into December.
You want to talk about the bond market move? That's something like 60 basis points month to date, encouraged this week by some choice comments, some selective hearing, maybe, from Governor Waller, who was basically saying something's giving and maybe it's this U.S. economy. There's one final chance to push back going into the quiet period. That is in the hands of Chairman Powell. Citi this morning saying Powell has the opportunity to push back against the cuts priced in when he speaks tomorrow on Friday. They call it a significant risk, but there's a big but here. If his colleagues are any guide, Powell's pushback will be limited and risk-on conditions will continue.
And that seems to be kind of the feeling that it's unlikely that he's going to come out and put the kibosh on a market rally, because he hasn't seemed to show any willingness to do that at the previous meeting, even though he had an opportunity to do so. People said that maybe he was coming out overly cautious and dovish. That said, the data has surprised the downside when it comes to inflation. It's why core PCE, the deflator indicator that we get in about a half an hour time, is going to be so important. Do we have the ongoing disinflation that's going to give them comfort that actually we are getting back to price stability?
Should we talk about Ford? I think we should talk about Ford.
Okay.
Ford in the pre-market looks like this. Ford this morning reinstated guidance, 10 billion to 10.5. That was lower than the previous guidance, which was suspended during the UAW negotiations. That was 11 to 12. But there are some massive differences out there between them and GM. GM, notably coming out with a $10 billion buyback program yesterday. We did not get that from Ford this morning. Ford saying the cost from the UAW contract are going to come to about $900 to each car, shaving margins by 70 basis points. That is several $100s more than what GM was telling us yesterday. Makes sense of that?
Well, they're saying it's for next year when a greater proportion of the contract goes into effect. I can't make sense of it. There is a component, as we were hearing from John Lawler, that there is a greater domestic U.S. focus of production of Ford. So maybe that's offset there, but it's unclear. And so it raises this question, first of all, how much is this a consistent cost? Second of all, how much clarity are we seeing in terms of what the costs are going to be and where they're going to be accepted? And third of all, just how much are we going to see this in margin compression? How much are we going to see this in higher prices? And what does this do to the competitiveness of U.S. auto manufacturers?
There was a key line from John Lawler, the CFO of Ford, in our conversation a little bit earlier. And I think it's a key line as we start to think about the jobs report next week. Here it is. We need to work on driving productivity and efficiencies and reducing the labor hours. Goes on to say the hours it takes to build a vehicle and reducing that cost. That, for many economists, when you get a labor market report, first thing to look for. Reduced hours, particularly when we're talking about holding on to labor because of the experience of the last 3 years. We couldn't hire quickly enough, so you're certainly not going to start firing. But if you want to make a move, if you want to pull back just a touch, productivity, of course, is one, but ultimately pulling back on hours worked, that's where you're going to see it first.
And that seems to be what's happening. If you take a look at the data, hours worked have been coming in slightly. But to your point, is this a template for what we're going to see elsewhere? That basically the way that you're going to offset extra cost is simply by increasing productivity, by reducing the amount people work and paying them de facto less, even if hourly they're being paid more.
TK said it yesterday, bombshell over at GM. I don't think just for the auto sector, I think a lot of people have got to look at that and think, oh, what's my move? What's my move into 2024? This is my move right now, this morning, and good morning to you. Here are the scores. Your equity market looks like this. Positive 1/3 of 1% on the S&P. On the session, on the month up big time. We've talked about that all morning. On the session, yields are higher. On the month, aggressively lower. Your 10-year yield at the moment, 4.2859. We've got some Fed speak through the next 24 hours. Some data 25 minutes away. At least the jobless claims just around the corner.
Yeah, are you focused more on jobless claims or core PCE?
I'm going to go with claims,
really?
To be honest with you.
That's
yeah,
interesting.
Yeah, just to see them hanging in there at 200K. Personally, I say that just because I was so surprised last week. The question I'd been asking for the best part of a month off the back of some of Data's research, which I know you're going to ask him about a little bit later, Neil essentially was saying for the Fed, the labour market is no longer a reason to be hawkish. So I think the equity market started to pivot to, okay, this is what I need to think about now. At what point is that labour market going to be a reason to be bearish? Watch claims. Claims had been pushing higher, and now they're back down to 209. Is that just a blip into Thanksgiving? Is this kind of data distorted somewhat? I don't know. But just to have claims still down 200K, near 200K, unemployment sat at 4%, deep into this hiking cycle is kind of surprising.
And it's a good point because when we talk about the disinflation, that's year-over-year comparisons, and Janet Henry of HSBC was just saying that come next year, those comparisons are going to get more difficult to beat. And so you might see a reacceleration of inflation. It really depends ultimately on labor market.
Absolutely. Joining us now on that, Steve Whiting, Citi Global Wealth Chief Investment Strategist and Chief Economist. Steve, good morning to you. It's always great to catch up, buddy. Let's just start with the Fed speak so far this week. Any reason to believe the message that we get from the New York Fed President John Williams, from the Chairman Jay Powell, is any different to what we've heard already?
Look, I don't think they can micromanage markets overshooting in both directions around their comments. It's actually good now to start getting the preconditions for the end of the tightening cycle, what it would take to ease these expectations, understanding that the Fed at some point is going to have to be forward-looking. It's not going to ease monetary policy when the economy has collapsed, right? If their monetary policy is restrictive, if inflation is falling to target, and I could definitely make the case for that, and employment decelerates, they're going to want to be careful about having restrictive monetary policy. Now, whether that takes 3 quarters or 2 quarters of time, that's the kind of thing that the economy will determine, right? But really getting this out and clear into the marketplace that their job is also not to force down the economy under every circumstances. That might be a little bit helpful, and I think the market has run off with that.
Given that, Stephen, are you leaning into what we've seen with respect to the bond rally? Do you think that the move that we've seen in November has legs, or was just another year packed into a month?
Look, I think it's a little too fast, but it's not too far. You consider where we think bond yields will be at the end of next year. We think 10-year yields will be 375. We think that the labor market is going to slow significantly. Fortunately enough, and this is the strange thing that's giving us a sense of bullish view of where we should be going without a contraction rebound cycle, is that a lot of industries have really contracted already. And if we were to take a look at their headcount, we're surprised it's not lower. Now, there have been other areas that have been asynchronous and employment is still growing. But we think that a lot of cyclical industries are going to find their bottom in the coming year and recover while the labor market is slowing, while measured inflation is coming down, and bond yields are moderating. So that's a different financial environment from what we've been in the last 2 years. And again, you could run away with that and go too far very, very quickly. I don't think that we really overshot where yields will be or where the equity market will be if we look out a little further.
So then how have you readjusted, Steve? I mean, if essentially you don't think it's overshot, it has moved fast, does that just mean that basically you're not going to do anything for the next 2 months and wait for things to sort of catch up, and then you'll take some action?
Well, okay, we've already made a bunch of changes, going back, particularly in October. Small and mid-cap profitable growth companies have had no return this year, and yet they're outgrowing large caps. And in fact, the growth companies don't have the highly indebted situation that small cap banks would. So we've added an overweight there. We think that a broadening equity market is the way that we will see the markets in 2024. It's not that we're going to get another 18, 19% gain in the S&P 500, but most stocks will be looking forward to a broader earnings recovery. So that's one way that we can play this. You know, another, again, is fixed income. Yields are down a little bit, but think about where cash will be in the next 3-4 years. The Fed's expectation for its long-term neutral policy, now whether it gets exactly to 2.5%, but that's where they are. So again, this rally in the bond market and thinking about some of the spread assets for high-quality bonds that are still north of 6%, you know, this is, again, the way you can still have higher for longer in your portfolio.
Steve, let's get into next year just a little bit more. Base case for a lot of people, slower growth, lower rates, which kind of screams growth and tech. Then at the same time, to your point, we are expecting this broadening out of a profits recovery. How do those two things compete with each other when we start to think about leadership?
Right. Well, look, Magnificent Seven have had a fantastic growth year. I mean, one semiconductor company has massive growth. If you take a look at the next 9, they don't. So when you think about valuation, I'm really not taking an active bet against large cap tech to really underweight or overweight. But the opportunity, again, in a world where a lot of the bond market in the world is still an incredibly low yield, 200 basis points below the US for other DM yields, is to take advantage of the catch-up, probably leaning a bit toward growth, but not in the largest firms, right? Think about all of the cybersecurity companies that are not trillion-dollar companies is one example of that. Think about some of the healthcare companies that look like they've had their first recession. And that is, I think, an opportunity for broadening in the equity market.
Steve, got to get your views. Steve Wine in there of City Global Wealth. Appreciate it. Looking ahead, Lisa, to next year.
Yeah, I mean, this is going to be a key question going forward of how you navigate this. Again, I just think big tech is going to be everything. You're laughing at me. Why are you laughing at me?
I'm not laughing at you at all. Why would I laugh at you?
I don't know. I could just tell. No, but honestly, look, it is exhausting a bit that we're going into the same.
I just love catching Bramo sort of like transfixed by cat videos on her screen. How you do that and provide world-class bond analysis is beyond me. I don't know.
You know, I've got to say, my experience.
One part's to like calm down half the brain and then sort of like keep the other side engaged.
I mean, basically, yeah.
I love that. If you are just joining us, welcome. Your equity market positive here by 0.3%. Yields are higher by 3 basis points, 428.59. Lots to discuss. I just think Neil Dutter's been great over at Renaissance Macro. I know I say it all the time, but he has been. He's going to join us in about 18 minutes' time. He was constructive on this economy when many other people weren't. He's looking at the data right now. And if you just listen to the guidance from Governor Waller, and I think this is probably what you're going to get into with Neil a little bit later, Governor Waller's basically saying if inflation continues to trend lower. And Neil's sitting there looking at the data, and many Fed economists are as well, suggesting, well, let's sort of probe that if. How much of a if is it? How big is that if based on what's already in the pipeline? And for many people, it's not a big if.
Well, and this is the reason why a lot of people are talking about rate cuts even without some sort of recession. What I want to hear from Neil Dutta is how do you pair the idea of a nearly 9% annualized GDP in the United States on a nominal level for 2024, if you just 2023, if you extrapolate out the third quarter, how do you take a look at that and think that this is going to be successful, that disinflation will continue, that you'll be able to have enough weakness to cause the nirvana of soft landing to continue?
I think it's the fact that we've had 9% nominal GDP in the third quarter, that we've got unemployment south of 4%, that claims are at 209, and yet we've still experienced this disinflation. I don't think anyone wants to extrapolate out Q3 to anywhere based on the growth we just saw. But even if you keep it at 2, you get a slowdown. That's what surprised me, that we've had this disinflation even with everything we're talking about in the labor market and beyond.
Which is the reason why I wonder, how much is this gas prices? How much is this durable goods? How much is this just a shift versus services and goods that continues? And how much is this just year-over-year comparisons that are just difficult to beat once again? I mean, again, can we really shift the whole narrative once more?
If you want. And also, I've thrown a new one, another one. How much of this isn't the Federal Reserve?
That's a good question.
It's a big one too. AMH up next from Washington, from New York. This is Bloomberg.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders.
Watch Wednesdays on Bloomberg Television.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Tuesday, a special episode of Bloomberg Surveillance live from Apollo's headquarters. Join Tom, John, and Lisa for exclusive interviews with top leaders in finance, including Apollo's Mark Rowan and Jim Zelter, about the state of private markets, recession risk in the new year, and deal-making amid high interest rates. It's all happening December 5th, starting at 6 a.m. Eastern on Bloomberg. Context changes everything.
From day one, we have been focused relentlessly on trying to secure the release of hostages from Gaza, from Hamas. This process is producing results. It's important, and we hope that it can continue. At the same time, I look forward to detailed conversations with the government of Israel about the way ahead in Gaza.
That was the U.S. Secretary of State Antony Blinken sitting down with the President of Israel in Tel Aviv early this morning as Israel and Hamas agreed to extend their truce by just one more day. With us down in Washington, D.C., we can say welcome back to Bloomberg's Anne-Marie. Hey, mates, let's get straight to it. An extra day. Why a day-by-day approach to this truce now? What's changed?
Well, the Israelis are really doing this day-by-day approach, and this one came down to the wire, Jonathan, about this extension. It does seem, when you look at what Israeli officials are saying, what the Israeli military is saying, is that this is only a tactical pause, and they want to make sure that they are going to eradicate Hamas. When you look at some of the statements, whether it's President Herzog or Prime Minister Netanyahu or the head of the Israeli Defense Forces. So it does seem that is why they're doing this day-by-day approach, also making sure they get these hostages out, which is why this trip Secretary of State Antony Blinken is making, his third since this war began, to the region, is so important at this moment, because it's clear from what the U.S. is saying, you know, behind the scenes and also in the open, that they would like to see a prolonged pause to make sure they can get all these hostages out. As on top of that, they want to see more humanitarian aid going into Gaza.
Anne-Marie, we've talked a lot about how there's been a lot of disagreement within Joe Biden's own party, with a number of lawmakers who are Democrats coming out and saying that they wanted conditions put around aid to Israel during this war. What's the latest on that? How much is the tide shifting in that direction versus sort of still supporting some sort of ongoing unconditional support of Israel?
Well, sometimes it's a hard line for this administration to walk. They had this bear hug mentality with Benjamin Netanyahu. The president went there, embraced him, said, we are standing shoulder to shoulder. They still maintain that, but at the same time, they are exerting a lot of pressure on Israel, because the images coming out of Gaza are horrific of the humanitarian toll this is taking, the civilian death toll of Palestinians, and that is why there's a lot more criticism from the public and from within his own administration about this policy. So you do see some individuals calling out the fact that they want some conditions attached. It doesn't seem like the administration is supporting that just yet, but potentially that's what might be on some of this aid if Congress is able to get this through, we could potentially see. But it is still a debate in Washington and is something that is looming large over this administration.
We'll get more on that throughout the days and I'm sure weeks ahead as this does evolve. I do want to just shift gears a little bit, Anne-Marie, and talk about the OPEC Plus meeting happening from COP28. The fact that it's virtual and that people are there talking about how they're going to reduce fossil fuel emissions while also negotiating how much oil they're going to pump. How much do you see this as really a result, the idea of making further cuts, as a result of U.S. production, not necessarily just diminishing demand from consumers?
I really see this as a price issue. You know, the Saudis continue to talk about market stability. And when you see the fact that what has it been, 10, 13, almost 15% in the last 2 months that oil prices have dropped, that's a concern for these oil-producing countries. Obviously, when you look at what the first quarter of next year looks like for the oil market, they are seeing a surplus. They want to flip that on its head. They want to see a deficit going into next year. So that's what this negotiation is about right now. I really think it comes down to market stability, or, you know, the diplomatic way of saying it comes down to price, although no OPEC energy minister will ever tell you that's what it's about. It is what it's about. They need to work out, though, whether or not they can get the likes of Angola and some other African countries to agree to lower quotas. And if not, potentially we'll just see a rollover of what they have established last month.
It sounds like a defenseless CEO of a company, doesn't it, when they just start to say it's the short sellers, speculators, Wall Street.
Yeah, pretty
it's
much.
Not the fundamentals of the company at all. AMH, what do they mean when they start talking about that it's the market environment, whatever they've said recently? What does that mean?
It means that they want higher prices. They want to put a floor under this. They don't want to see the dwindling of oil prices around the world. And they want to make sure that they're putting the speculators in the market. I mean, Prince Abdulaziz bin Salman has never been shy about calling out the speculators and telling them to dare him or tempt him. So I think that's what this is about. But it comes at a time when, you know, I don't think there's a lot of friction right now. Well, you'll see friction if OPEC Plus does decide to take this next step in a million barrels cut with the administration, because gasoline prices are lower right now. They could potentially give this one to the Saudis. They are helping them in the region right now with this war. Things are stable at the moment, at least in terms of this has not become a wider conflict. So potentially they do give them this out and they shrug this off where gasoline prices are, but potentially this could look a little bit different as we go into November of next year.
You've covered this for years, and I know this is slightly unfair, but based on your coverage, what is the number they want? Right now, Brent crude's at 84. If they're not happy with that, what are they happy with?
I mean, I think the Saudis deep down would love $100 a barrel of oil, but maybe something closer to 90. Certainly put a floor at 80, 85, but I think something closer to $90 a barrel. I mean, the IMF for years has said that's where their budget would need to be in line with. But yeah, around 90 to 100, I would say, would be their sweet spot.
AMH, thank you. The latest down in Washington, D.C. Anne-Marie Hordern there. On OPEC Plus, a virtual get-together after cancelling the in-person get-together in Vienna. Manus Cranny very disappointed, by the way. Yeah, Manus thought he was going to get on a flight to Vienna and, you know, stay at the Ritz and all of that good stuff and then talk about oil. That's not happening. Coming up at the Open, this is happening on Bloomberg TV. We'll catch up with Priya Misra of JP Morgan, Krishna Mamani of Lafayette College, Stuart Kaiser of Citi. Lisa, I know you've enjoyed Stu's research over the last few months. A rally, and a massive month-to-date rally on the S&P 500 and on the NASDAQ. Stuart's point is this is not just about the bond market. This rally this year has been built on good data. And he says when that data starts to turn, you need to turn away as well and run away from this equity market. Until then, stay constructive. Jobless claims about 8 minutes away.
Good news is good news. Bad news is bad news.
Yeah, in Stuart's mind, yeah.
Yes, and the fact that he has to say that tells you where we are in this sort of upside-down world, and the fact that that's so controversial to say good news is good news and bad news is bad news gives you a sense of just where we're at in terms of this year. But I am curious to see how he paints that in terms of the tipping point and whether there's any leading indicator at a time where people are saying the jobs market's going to be lagging, that we're not going to really be able to trade the weakness until it's already too late when it shows up in the job market.
Drum roll, JP Morgan and a team. You know, 4,200 on the S&P 500. It's quite a price target. Against the grain, we got 5,100 at Deutsche Bank, 5,000 at Bank of America, 5K at RBC, and there's JP Morgan, bottom of the pile in the investment bank, looking for 4,200 with a downside bias. Their words, not mine. Absent rapid Fed easing, we expect a more challenging macro backdrop for stocks next year, softening consumer trends at a time when investor positioning and sentiment have mostly reversed. You said it earlier. I completely agree with you. Put the number to one side. When you go through the logic from the team over there, it's hard to argue against it.
To me, the big question is tech, because that's been the driver, and that's been such a big proportion of overall returns. How much is this just a call on tech? Because the Russell 2000 has done nothing. Banks have done nothing. A lot of the consumer discretionaries, yes, you've got the airlines, yes, you've got, although they're, hit or miss, and then you've got the cruise liners that are doing well, but a lot of the others, not so much. So what are they talking about? How much does that composition shift? And increasingly, I mean, remember when we didn't really care about composition? It was just everything goes up or everything goes down. And suddenly now it matters.
Hang on a minute. This month everything has gone up, right?
Yeah.
Energy's had a tough time, but stock market, index, bond market rallied.
I'm talking about back in the day.
No, I get that. I get that. It was
like
good times. We're reminiscing, nostalgia, all of that good stuff. All right. Equity futures, positive a third of 1%. Jobless claims, 5 minutes away. Neil Dutta, Renaissance Macro, is going to break down all of this with Lisa around a table here in New York. From New York City, good morning.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
until the market opened, about seconds away from some key economic data, including core PCE, the key indicator that the Federal Reserve looks at to get a sense of inflation, as well as initial jobless claims. Taking a look at markets, you are seeing a bit of a pause, at least in the incredible bond rally that underpinned, but not much. We've really come in with yields nearly flat on the day, 427.24. You can see the S&P futures continuing with a lift, up 0.3%. The NASDAQ this month has just been amazing, 11% gain so far year to date. We are getting some of that data coming through. With that is our very own Michael McKee. Mike.
Well, in John Farrow's honor, I'm going to start with jobless claims, 218,000. That's bang on what had been forecast. And continuing claims rise to 1,927,000. Last week, it was 1,840,000. So a slight rise in jobless claims after last week's fallback. Now, we have to caution that a lot of economists are noting this could be distorted by the fact that last week, or the week in these surveys, is Thanksgiving. And so we may see some unusual numbers for that week, but it doesn't suggest that we're having a huge situation with a lot of layoffs and things like that. Personal income up 0.2% after 0.3 last month. Spending up 0.2. Both of those are exactly what was forecast. 0.7 personal spending in the month of September. The deflator for PCE headline is flat, 0.0 after 0.4, which drops the PCE deflator on a year-over-year basis to 3%. That's obviously the lowest since the pandemic began. Core comes in at 0.2, which is what was forecast, down from 0.3 last month, pushes us down to 3.5%. So basically, Lisa, what we've seen is what was expected. Economists forecast jobless claims, spending, income, and inflation pretty much exactly on the nose.
So let's just take you through some of the reaction. Not a lot of drama, as John would say. What you're seeing is a little bit of a decline, a little bit of a dip in bond yields. You're seeing a little bit of a pop in equity markets as they parse through a bit lower than expected, although not significantly so. Inflation read in an inline jobs market that did have at least continuing claims tick up a little bit more than expected to 1,927,000. Mike, when we take a look at this sort of ongoing disinflation and steady labor market, how much can you pair this with what we saw from the Beige Book yesterday, and the sense that anecdotally you are seeing a tightening of the labor market, but it may not be happening in the same kind of way as mass layoffs?
Yeah, what we saw in the Beige Book was, though, the first indication that companies are starting to say they feel okay with doing some layoffs or letting jobs go via attrition. That's a new development, because up to this point, everybody's been trying to hire as many people as they can, or at least hold on to them. So we'll have to see if that gains momentum. It wasn't mentioned as a major trend in the report, just something that had changed. Claims at 218, still very low. Last week was revised up to 211 from 209. So we're not seeing a major trend in layoffs, but we do see more people on continuing claims for a longer period of time. So some indication of softness in the labor market. Now we'll see what happens with income and spending up 0.2. It's still strong, but not hugely so, not like it was in prior months. So we'll see how whether that rebounds or not, and how companies react to that.
We're about 42 minutes away from hearing from New York Fed President John Williams on Friday. Tomorrow, we're going to be hearing from Fed Chair Jay Powell. Citigroup's Andrew Hollenhorst posting that he does have an opportunity to push back on the idea that this disinflation will necessarily lead to rate cuts in the first half of next year by the Federal Reserve, as the market seems to be pricing in. Based on what we have heard, do you agree with Citigroup's assessment that it seems unlikely that he would come out and try to jawbone the market one way or another and push back on rate-cutting claims?
I don't think he will necessarily push back on rate-cutting claims. If he gets asked about it, he would say, we're not talking about that yet. They're still going to be in that mode. I think Tom Barkin put it well yesterday. He said if inflation continues to come down, great, and he's certainly not going to push for a rate increase if it does. But if it doesn't, they should leave it on the table, which is, I think, where the Fed wants to be at this point, because they don't want the markets going too far. The interesting thing is, nobody is arguing with the idea that the Fed is going to cut rates in 2024. The Fed said it was going to cut rates in 2024 in the September dot plot. We'll see what they do on December 13th, but it's really a question of how fast inflation comes down and we're not really talking about, Bill Ackman said the first quarter, we're not really talking about whether or not somebody is predicting this or that time period for the Fed. Look at what inflation is and how fast that comes down, and that'll give you a better idea of when the Fed's going to be thinking about it.
Michael McKee, stay close, please, as you parse through the data. We'll catch up with you in just a bit to get more details. Right now, we're going to really get into the details of a soft landing nirvana that has come through the data again and again. The words of Neil Dutta, head of economics at Renaissance Macro Research, joining us now, fresh off his Thanksgiving holiday. Neil, does this data just sort of underscore the soft landing nirvana that you really pinned over the last few months?
Well, thank you, Lisa. You're giving me too much credit. I think I pinned it over the last few weeks. But, you know, I do think that the data is lining up, and we're on a glide path now to a rate cut probably by March, frankly. If you look at core PCE inflation since June, it's up just 2.3% at an annual rate. And there's a lot of disinflation in the pipeline, as we know. We know that you know, when we look at car prices at the wholesale level, that's declining. We see that pretty much month in and month out. That's going to bleed into core consumer prices over the next few months. We know that rental inflation is moderating. That's going to also bleed into core inflation over the next few months. And the normalization of supply chain should take pressure off of prices for core consumer goods outside of cars. So I think it's highly likely that you know, core inflation is you know, running sub 2.5%, probably, you know, on a 6-month basis by the first quarter of next year. And you know, when you think about, the Fed is giving us the playbook. I mean, if we just want to read it, Waller basically told us this week that he's following sort of a standard Taylor rule type of framework. And if inflation slows, the Fed will cut. It really is that simple. Well, I don't want to make a judgment about whether that's right or wrong, but that's what they're going to do.
But
so
Neil,
I think, sorry, go ahead.
No, sorry to cut in here, but I'm just struck by what you were saying earlier in the year when you were saying people have underestimated how much momentum there is in the economy, and that come next year, we're going to be surprised by the stickiness of the inflation, the stickiness of just what we see in terms of growth. How do you pair that idea and the fact that we continue to get better than expected economic data? How do you pair that with ongoing disinflation in tandem with what the Fed was hoping for, and even then some?
Well, I mean, the economy is holding up, but it's clear that there's more disinflation despite that growth. And, you know, I think the Fed is looking at what's happening with realized inflation, right? So the fact that actual inflation is moderating, that will pressure them to cut interest rates because they don't want to get real interest rates in their framework unduly high, too high. And so I think really that's what it comes down to. And as I say, I mean, part of this job isn't so much what I think they should do, but what I think they will do, and what they're telling us what they will do. If inflation continues to come in like it's been coming in, the Fed is going to respond to that. I don't think it's a situation where they're cutting aggressively. I mean, I think part of the issue right now, Lisa, is that, you know, a lot of folks aren't used to the Fed just surgically cutting interest rates. I mean, it's usually they do a lot or nothing at all. But I think what we're talking about for next year, for 2024, is really a recalibration of monetary policy. Not unlike, frankly, what we saw in 1995, where the Fed came off of a year of very, very aggressive tightening and cut rates a few times, trying to you know, fine tune you know, their monetary policy, which frankly I think, you know, they can justify that based on the inflation data as it's going to come in.
Neil, I know that earlier in the year you were also talking about how inflation is going to be higher for a longer period of time. Do you still think that?
I mean, I do, but the question is around the time horizon. I mean, I think that the economy is growing above trend. That's ultimately going to have some effects on prices. But you know, there is a lot of disinflation in the process and in train, and the Fed is going to respond to that. You know, the issue, frankly, is does the soft landing enthusiasm today, does that reignite inflation later? I think that that's something the Fed should keep in the back of their mind. And frankly, that may be one reason, you know, kind of puts a ceiling on how many cuts they can do. But I do think we have to get through this period of disinflation first. And I think the Fed is going to react to that disinflation, which is why I think they'll cut interest rates. And they'll probably front load the cuts and sort of get it out of the system quickly. Look, they're already telling you that they're going to cut rates. I mean, they were at 4 in June, as Mike mentioned. They went to 2 in September, and they might signal that a pause in December and pencil in three cuts for 2024. I mean, that doesn't tell you when they do it, and that's why I say I think given the glide path and inflation that we're likely to get, they probably do it sooner than later.
Neil, I'm curious, from your vantage point, a lot of people have been saying it's going to be the bond market's dream and that you're going to get an ongoing rally in bonds, that will tee off an equity market rally. Do you agree with that type of recipe, or do you think that it's not so simple, especially if there is this longer term question embedded in bonds of what the new neutral rate is, that actually solid inflation, but not overly hot, a bank that's a central bank that's surgically cutting, that's really positive for risk, but not necessarily on the other side for bonds?
Well, I mean, I think it probably may weigh on longer term rates, obviously, right? I mean, but again, for the stock market, I mean, it's ultimately an environment where companies can make money, which should continue to help, stock prices go higher.
Neil Dutta of Renaissance Macro, thank you so much for being with us and for the incredible phrase, soft landing nirvana, which we do keep using again and again, because it does so perfectly explain where we are at a moment where suddenly people are piling into bonds, and that is supporting the equity market. Right now, we continue to see that support to equity valuations after economic data coming out, basically in line with expectations. Just to go through the numbers, if you are just joining, initial jobless claims came in at 218,000, exactly bang on what people expected. A little bit of an upward revision, but no drama in terms of the prior month. Continuing claims did come in a little bit higher than expected. Personal income and spending both came in basically in line. Real personal spending a little bit higher. And interesting that the PCE deflator, this is sort of one of the key indications that the Fed looks at to understand where consumer prices are headed, came in just a tick below expectations, 3% year over year from the expected 3.1% and down from 3.4%. That bleeds into the market with bond yields basically going nowhere after an incredible rally, having been up about 4 basis points earlier. They've gone back to that now, 4.2955 on the 10-year. S&P futures up 0.3%. With us, we do still have Michael McKee of Bloomberg Economics, our correspondent, our fearless Fed correspondent as well. What are you looking at when you parse through these numbers that stands out to you?
A couple of the most interesting things. Wages and salaries in October are the lowest in quite some time, just up 0.1% after many months of 0.5% and 0.4%. So we are finally seeing a deceleration. Of course, standard caveat, 1 month does not make necessarily a trend, but this is what the Fed has been expecting. So it will be interesting to see if that continues, because the real drop was in private industries and in manufacturing, areas where people get paid more money. Those have fallen. Manufacturing was flat, and private industries just up 0.1%. Both were up 0.5% in prior months.
Is this basically the playbook, that this is sort of the first signs of a squeeze that then kind of get carried out in more aggressive actions like cuts? Is this sort of how it typically happens, or is there still nothing typical about this cycle?
Well, there's nothing typical about this cycle, but if we are going to go into that kind of environment, this is how it would begin. It doesn't necessarily mean that we go down that slope all the way. For example, we've been talking quite a bit about whether or not Americans have exhausted their pandemic savings. Well, the savings rate went up in the last month to 3.8% from 3.7%. So there's still a lot of we don't know out there.
That's a good way to say it, especially with the real personal spending coming in higher than expected. Coming up, someone who has been a long-term bond bull, made incredible returns during the era of zero rates, and now is facing off what he thinks is another massive bond market rally. Lacey Hunt, Executive Vice President and Economist at Hoisington Investment Management.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
To the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
I think it's going to all be about rates, and I think that you've gone through this sort of incredible whipsaw where you know the long end of the curve was a one-way short bet. Now it's a one-way long bet. I think we're going to end up with the 10-year back in that 4.50 to 5% range. And I think the economy's okay. I mean, I don't think we're pre-recession.
That was Michael Schall, CEO of Marketfield Asset Management, just a bit ago as he laid out what he sees as something more of a trader's market, with equities still kind of hanging in there as we are not in some sort of recession. Equities certainly hanging in there after a pretty amazing month, at least when it comes to some benchmark returns. Certainly in equities, you look at the NASDAQ, the best returns that we saw since earlier last year, up about 11%. S&P futures up about 0.4%, adding to the gain that we've seen of about 8% so far this month. This all on the heels of a bond market rally that has been the biggest rally for U.S. debt going back for a month since 1985, which is a reason why I am so thrilled to speak with Lacey Hunt, who is Executive Vice President and Economist at Hoisington Investment Company in the 54th year of his career, someone who made a name for understanding financial repression, for understanding low rates based on low growth and low inflation, and who has some unique perspective on where we are right now. Lacey, so great to have you on the show. What do you make of what we just saw for the month of November, the biggest bond rally in U.S. debt going back for a month since 1985?
I think it indicates that the economic risks on the downside have increased at a time when most Americans are suffering hard times. And in the past, when this has happened, and based on economic theory, the bond market should rally, and that's what happened.
We're looking right now at hard times when it comes to anecdotes, when it comes to the beige book, when it comes to sentiment in certain quarters, not so much when it comes to spending. We just got real spending that surprised to the upside. We saw an incredible Black Friday tally. We saw record Cyber Monday sales. We're seeing ongoing strength in the labor market. Where do you see these signs of something that looks more like a hard landing than the soft landing nirvana we were just talking about with Neil Dutta?
Well, there's two equally important concepts in economics. Is what we spend and then what we earn. And there has been a massive dispersion between the two. In the last 4 quarters, gross domestic income is actually down 0.2% in real terms, whereas real GDP is up 3%. But we've never had such a wide gap. And the time that we had a gap that was similar, but not nearly as large, was the third quarter of 2007, and the next quarter we were in a recession. So there's an amazing discrepancy there. Another discrepancy is that we are seeing gains in employment, but the work week is being shrunk. And if you look at the hours of all persons worked, it's actually declined over the last 6 months, as the work week is more than negated the gains in employment. And if you look at how people respond to the outstanding University of Michigan survey, they say they're absolutely wretched, and they should be, because for most of our people, incomes have fallen badly behind inflation. And in fact, the University of Michigan readings for several months have been below where we entered the recessions of the post-war period. There are a lot of problems that this economy faces. In addition to that, we have extremely restrictive monetary policy, and fiscal policy is in a non-sustainable situation. If one looks at monetary growth on a 1, 2, and 3 year basis, we see that all the stimulus of 2020 and 2021 has been eradicated. Historically, my preferred measure of money grows at 3% per annum. It's currently contracting at 1% per annum over the last 3 years. And another totally contra-normal cyclical development, bank credit has declined over the last 1, 2, and 3 years. That's totally abnormal.
Yeah.
Because bank credit is a lagging indicator. It doesn't typically peak until the economy gets into a recession. And another monetary indicator, which us old timers use, is known as the Wicksell effect. Wicksell, I should say, for the Swedish economist. He looks at the relationship between nominal growth and market rates.
Yeah.
And if you use the average of income and spending, the Wicksell effect is got the market rates 100 basis points over the natural rate, which is a restricted condition.
Lacey, forgive me. I want to dive in. You're talking about a lot of things, and I want to unpack some of it. So just I apologize for cutting in here, but there is this question.
Everybody.
There's a question here about when you talk about the fiscal picture and how it feels unsustainable, and then you're talking about very restrictive monetary policy. Is it clear that the trajectory is back down to a 10-year yield below 2% or below 3%? Or is the 10-year yield that much more confusing because of the conflicting signals from both monetary policy and a fiscal policy that faces off with a whole host of bond issuance?
I think that interest rates are lagging economic activity. I think money supply growth. I think that the trends in these various critical monetary variables lead. The financial cycle leads the business cycle, and the business cycle leads the labor and the price cycle. And this is a sequence that's been well worn out over time. The financial cycle peaked in the first quarter of the fourth quarter of 2021. The normal lag is 5 to 9 quarters. That's where we are right now. We're in the 8th quarter. These monetary effects are very, very profound. Fiscal policy is also not sustainable. The chairman of the Federal Reserve said that just recently, and he should say that. We've created a situation now where our net national saving is negative. In other words, the government budget deficit is greater than private saving and the foreign saving. And in fact, we just experienced the 3rd consecutive quarter of negative net national saving.
Yeah.
And without saving, you're not in a position to have investment. Without investment, you're not able to effectuate an increase in the capital stock. So without an increase in capital stock, you cannot raise the standard of living. The economy has cyclical problems and has secular problems.
Just quickly here, Lacey, I'm curious then what your new projection is. How much further you think the rally has to go that we just experienced this month?
Well, we're not in a position to give you an individual rate, but I can tell you that Lexington Management has an 18-year duration, which is a very strong statement that we expect a substantial decline in rates over the next several years.
And do you think this is going to come on inflation going substantially lower? Are we going back to the same kind of inflation that we saw before the pandemic?
Yes, one of the very interesting things is that this year we've experienced nearly 600 basis points decline in the inflation rate, while the economy was still expanding, at least in the GDP terms. That doesn't happen. The inflation rate has fallen by 600 basis points in the past, but never when the GDP is rising. And if we get any type of mild recession, if you look at the average inflation rate since the recession since the 1950s, the inflation rate averages 1.3% at the low. There's a lot of restraint in the system. restraint is moving into the system even here in November. The Federal Reserve has liquidated $60 billion worth of permanent reserves. We're seeing actually now a nominal decline in commercial and industrial loans and some of the other critical lending categories. This is an indication that the restraint is moving through the system. And these have effects, especially at a time when so many people are doing so poorly.
Lacey Hunt, thank you so much for being on with us. Lacey Hunt of Hoisington Investment Company in his 54th year in the bond market at a time where people are wondering how much can this bond market continue to rally. The best, biggest U.S. bond market rally going back to 1985 at a time when people are talking about rate cuts and what's next for an economy that has been highly uncertain. Right now in markets, we can see a lift to equities as we head into the final trading day of November of 2023, up about 0.25% for the S&P, 4570. Just amazing that would have been a year-end target for 2024 for so many people if they wrote their outlooks in November. A bit of euro weakness after a weaker than expected European inflation data, raising the prospect of possibly getting ECB rate cuts earlier in the year and really just throughout next year. 10-year yields up now, creeping a bit higher, up almost 6 basis points, 431.09. Still lower, though, from some of the recent highs north of 5%. Coming up on Bloomberg Television at 3 p.m., Lisa Shallot of Morgan Stanley Wealth Management as we get you through this day.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
Keeping the faith in billionaire Warren Buffett. The legendary investor turns 93 this August. His signature must-read letters to shareholders have been getting shorter and shorter. This year's letter contained few fresh ideas. But most investors in a Bloomberg survey say Buffett's steady Eddie approach of buying cheap, safe, high-quality companies will beat the market. They expect returns in his investment company, Berkshire Hathaway, to outperform the S&P 500 over the next 5 years, adding to an incredible run in which Berkshire shares have returned more than 3 million% in the almost 6 decades Buffett has led the firm. Investors are also willing to pay up for Berkshire, which owns everything from the railroad BNSF and car insurer Geico to See's Candies and Coca-Cola. About 1/5 quantify the Buffett premium at more than 10% of Berkshire's stock price. More than a quarter say it's somewhere between 5 to 10%. There is one problem for Berkshire Hathaway, its size. Thanks to a bunch of cash-generating insurance companies, Berkshire has at least $130 billion in cash that it can put to work. But it needs big acquisitions to move the needle. Buffett calls it hunting for elephants. And we know Buffett hates overpaying. So that means sitting tight, patiently waiting for the right moment to pounce on the right company, which might be a drag on performance for now, but as Buffett fans know, usually works out in the long run.
So let's go inside the boardroom. Let's suppose you win a proxy fight and or you just get invited onto the board. You go to your first board meeting and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with a plan.
This is Bloomberg.
Let's get your trading day started. Live from New York City this morning. Good morning, good morning. Your equity market, what a month in November. Can we add some weight to it? Equity futures up 0.25%. A countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, stocks and bonds close out the best month of the year. Saudi Arabia pushing OPEC to constrain supplies, and Elon Musk has some choice words for advertisers. We begin with the big issue, the everything rally. Check it out month to date. What a move in this equity market. On the S&P, up by 8.5%. On the NASDAQ 100, the best month since July of last year. Double-figure gains. And look at this. The two-year yield down more than 40 basis points in November. The two-year on October 19th was 5.2571. Right now, 4.6864. And we have had a 61 basis point move lower on a 10-year. 432.25. Equities rip, treasuries rally, yields drop. Can this continue? Joining us now to discuss is JP Morgan's Priya Misra, Krishna Mamani of Lafayette College. Priya, let's get straight to it. Can this everything rally continue next month?
Sure. Thanks, John. So, I think this has been all this immaculate disinflation, soft landing. Essentially, that's what's priced in. So, the risk to this would be either that inflation does not decline in a straight line. I'm somewhat sympathetic to that last mile issue. And I think the market's a little bit run with the idea that the Fed will be cutting rates, even with the unemployment rate, around 4%, because inflation's going to be down to 2%. I think that's a risk here that we should monitor. I'm going to be watching every inflation print. The other risk is that it's not immaculate, meaning that the economy actually can slow down faster. In that scenario, the Fed does cut rates. So I think we remain in this bimodal world where soft landing, I think the Fed stays here for a while. Hard landing, the Fed will have to cut a lot more. But in both these scenarios, I think this everything rally remains challenged. But, we're heading into the end of the year. If the economic data remains okay, which we think right now it is okay, we're in a soft landing right now. I think, the market can continue to be in this FOMO world. I think people didn't own enough duration risk. People didn't own enough credit risk, enough risk assets. Everyone, cash has felt good this year. So I think that's why this FOMO rally, in a way, can continue into year end. But I think as we think about next year, we should be mindful of those two risks. Does inflation come back down enough to 2% or below to allow the Fed to cut? And does the economy hold up? I'm sort of nervous on essentially both ends of that risk spectrum.
Let's unpack that. You made two broad points there. One on the fundamentals, the second was on positioning. Krishna, let's talk about positioning. You and I have talked about the path of least resistance through the year, and I remember very early on in 2023, you said the upside risk was the biggest risk here. That was the path of least resistance for equities. Krishna, do you still share that view, given the reversal we've seen, the big rally we've seen over the last month?
I think the big rally last month was because of big correction in September and October. So if you kind of go back, we have been here, not exactly here, but not too far from here either. So I think the outlook for December and January, for that matter, I think is we are still in a trading range. As Priya said, there are lots of data points to kind of be cognizant of and therefore monitor how things unpack, because the path of inflation and the quickness of that path down, I think is going to be critical. Having said that, I think if you have a one-year investment horizon, and at this point it's probably the right investment horizon to have for 2024, there are a whole lot of things that can fall in place rather well. So let me highlight that. That is, you can have an economy that does reasonably well. Not 5%, but 2% is definitely in the cards, given the momentum in the economy and where employment is. Second, inflation continues to come down, and I think the risk of inflation ratcheting back up at this point, based on all the things that we have seen, despite Priya's concern, I'm somewhat more sanguine. The more and probably the most critical thing in my judgment is where real rates are. Real rates today are 2.5%, let's say rough terms. there is absolutely no reason for an economy growing at 2% that real rates have to be at 2.5%. They don't have to be negative, they don't have to be zero, but they don't have to be at 2.5%. If that comes down to 1.5%, I think the outlook for risk assets in 2024 can be substantially better than what we can foresee today.
Priya, let me give you some time to respond to that. Just on the last point, what are your thoughts?
Sure. So I would agree with Krishna. I think for risk assets to do well, those real rates have to come down. What helps real rates come down will be the Fed having to start to cut rates. So is the soft landing predicated on the Fed starting to cut rates? I think the market loves that idea. I'm not so sure that the Fed will be that quick. I mean, they've lost a lot of inflation credibility. They want to put that inflation genie back in the bottle. Either the unemployment rate, I think, closer to 5% or inflation at 2%. And I know inflation's been coming down significantly. If that decline starts to stall, I would argue that the Fed's going to be the bar for the Fed to cut rates is high. So we may be in this uncomfortable position where we want those real rates to decline, but how do you get it to decline? We need the Fed to respond. And I think right now they're going to be happy to just buy time, wait for data. And until inflation doesn't get to 2, I don't think those real rates come down significantly. So I think that's why that's going to be a risk for the market looking for these lower real rates. But absolutely, I agree with Krishna. I think 2.5%, 2% real rates, the economy can't handle. And so at some point, those lags that we've talked about for the last 2 years, I think those lags start to play out, things start to slow down. Everyone will watch the Fed. Can they be preemptive? I just think the era of a preemptive Fed that's cutting rates to try and engineer that soft landing, I think that's behind us.
We're all looking for Chairman Powell about 24 hours away. Let's get to Mike McKee for more on the Fed speak. Morning, Mike.
Good morning, John. It'll be interesting to see if Chairman Powell pushes back on this market idea that we're going to see rate cuts fairly soon. The numbers all suggest at this point that we're seeing a possible soft landing scenario. The Fed's not going to embrace that quite yet. You see jobless claims moved up just a little bit. Continuing claims moved up more than anticipated, suggesting people are having a harder time getting new jobs if they've been laid off. And we did hear some of that in the Beige Book yesterday when the Fed said that some companies are reporting they are not filling jobs through attrition, and some companies are actually feeling okay about maybe letting some people go. Personal income, interesting story here, up 0.2, half of what it was the prior month, but wages up only 0.1%, and that is the lowest since last December. They accelerated again, but maybe that takes some of the pressure off inflation. They look at PCE inflation, everything's come down, headline and core, and the super core that Jay Powell likes to look at. Mary Daly just out on the wires with an interview in a German newspaper suggesting the Fed cannot say that it has defeated inflation yet, and we are not talking about rate cuts. But yes, they are. The dot plot that they put out in September suggested they're going to cut rates this coming year. It's only a question of when, not the fact of if. And if we see the real rate continue to rise, it may come sooner. And the real rate would rise because inflation comes down faster. So what we're really talking about here is what Wall Street's prediction is for the path of inflation. There could always be a recession that would cause them to cut rates, but right now the data we're getting, John, don't suggest that that is the scenario ahead.
Mike, thank you, buddy. Always enjoy catching up with you, sir. Jobless claims speak to that. Jobless claims at like 218, still exceptionally low. A bit higher than the previous week, but exceptionally low on a historical basis. Chairman Powell tomorrow. Here's Citi's Andrew Holdenhorst. Powell has an opportunity to push back against the cuts priced in when he speaks on Friday. They call it a significant risk, but, and a big but, if his colleagues are any guide, Powell's pushback will be limited and risk-on conditions will continue. Krishna, do you agree with that assessment?
100%. I think if you kind of think about it, the biggest hawk out there and probably the most credible hawk out there is Waller. And he basically laid out the path with the Wall Street Journal interview, which is if the current trends continue, and he was even more specific, 3, 4, 5 months, he doesn't see real policy rates remain at current level in that sort of an environment. So and Williams has been saying that for a long time. So I think both sides of the FOMC have indicated, and as Mike McKee pointed out, they have actually put it out there in their forecast. I think we have to take them at their word. That is, what we should be looking for is the trend in the data. And if the data continues on the current path, saying that they won't do anything by, let's say, May or June of next year, I think it's kind of making certain assumptions about how things will work out on the data front.
Well, Krishna, we've got to make some assumptions. That if, let's talk about that if in that quote you shared from Governor Waller. How big is that if these trends continue? The communication we've had from the Fed this week, Waller, something is giving. It's the economy. Bostic, downward inflation trajectory will continue. Priya, just how much disinflation is already in the pipeline over the next few months?
Sure. So I think the base effects are essentially going to move that year-over-year number lower. The fact that, we're coming off high inflation prints. But I still go back to the labor market. The labor market is tight. Wages are coming down, but I think where wages are is not consistent with the 2% PCE number. And that's why I think when the Fed thinks about inflation, there's absolutely disinflation in there. The supply side, demand side started to come down. But are we consistent with 2%? I think they really want to keep inflation expectations anchored, and they don't want a significant easing in financial conditions. So I think what they're going to say is there is a path for us to cut, for the Fed to cut rates. That path requires inflation convincingly at 2%. And the other path, I think they're not talking about that. The market should price in the other path, which is even if inflation's above 2%, if that unemployment rate starts to get dangerously north of 4%, they may have to cut. So I think we're still going to be debating this hard landing, soft landing. I know the data is looking very soft landing-ish, but it's all predicated on that inflation that's been declining. And I think I think Chair Powell's going to hedge a little bit and say, we're not talking about cuts here. We can cut, but we need that inflation convincingly closer to 2% from the labor side as well.
Priya, what I hear from you is that the bar for cuts is higher than people think. And I think what the media always obsesses over is calendar-based guidance, calendar-based calls. Tell me, is it May? Is it June? Is it somewhere next year, the second half, the first half? I want to talk about threshold-based guidance. Priya, what are the thresholds? You alluded to them just there. I suggested earlier this week, based on research from Standard Chartered, that maybe it's 4%, 4.5% unemployment and core PCE at 3%. That was their call. What are you saying it is?
So I would say anything above 4.5 will make them nervous on the unemployment rate, with an if that's not driven by participation going up. If this is, negative payrolls or zero payrolls for a few months, you're going to get that rise in the unemployment rate. The Fed thinks NAIRU, or the non-exhilarating rate of unemployment, is about 4%. So if you're significantly above that, 4.5, 4.75, I think they start to cut rates. They might even ignore inflation above 2.5 in that scenario, because inflation, we know famously, is lagging. And so if the labor market's weakening significantly, I think they cut rates. But in the scenario where we're in right now, the unemployment rate around 4%, I think they need PCE much closer to 2% or almost below 2% for them to start to cut rates. I think the Williams-Waller argument of keeping policy at the same level of restrictiveness requires an assumption on R-star, and we've all become a lot more humble on what exactly R-star is. And so I think the Fed will want clear signs that the inflation is not above 2% before they cut. So I can see the two states of the world. I think 4.5 or 2, a combination of that will allow them to cut, to keep policy at the same level of restrictiveness. We're not there on the inflation front.
Priya Misra, sticking with us alongside Krishna Mamani. We are about 17 minutes out from the open bout to close out the month of November. Equity futures positive here by 0.2%. Let's get you some movers. Here's Abby.
Good morning, John. And adding to the bullish tone, we do have a few movers to the upside, starting out with the shares of Salesforce.com. They are popping sharply higher this after a third quarter beat right across the board, in particular, 19% profit beat. It is seen as a low bar quarter, so expectations were low going into it, but they exceeded. They also raised the profit outlook, perhaps having to do with the jobs cuts that were announced over the recent last year. Morgan Stanley, though, does have some questions on Gen AI for 2025. Snowflake, a similar deal, up 7.3%. They beat and raised for that cloud company, offering some hope for revenue stabilization after a slowdown. And then Tesla, it had been up more than 1%, right now up about 0.3%, of course, after Elon Musk's bold, wide-ranging interview at the New York Times Deal Book Conference ahead of today, which, John, of course, I know that you're excited for it, is the big Cybertruck event.
Yes, very much so. Abby, thank you. We'll catch up with Ed Ludlow on that in just a moment. Coming up, US automakers making their pitch to Wall Street.
We never thought that the
EV adoption would necessarily be a straight line. We've seen this in other markets. We're seeing it now in the U.S., but I think the thing that everybody has to remember, if the growth is slowing, it is still growing.
New guidance from GM and Ford in the past 24 hours. That conversation up next.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep rain World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
We never thought that the EV adoption would necessarily be a straight line. We've seen this in other markets. We're seeing it now in the U.S., but I think the thing that everybody has to remember, if the growth is slowing, it is still growing. We think we're going to see a strong adoption for our products, and as the charging infrastructure continues to be more robust, we think that's going to drive adoption, as well as having affordable EVs.
Much more difficult than they expected. The race for EV domination heating up. Legacy automakers struggling to sell EVs at a large enough volume to compete with Tesla, dealing with production issues and downshifting plans for factory openings, citing low demand. But GM and Ford both insisting an EV customer base exists. Your team coverage starts right now. Bloomberg's Katie Greifeld and Ed Ludlow joins us. Katie, good morning.
Good morning. And yeah, those question marks over EV demand help explain why you're seeing pricing come down both at Tesla and these legacy automakers. From your interview this morning with Ford's CFO, John Lawler, he said that they've seen EV prices come down, quote, much quicker than we expected. And that's because while early adopters were willing to pay a premium here, that's not necessarily true as the EV customer base broadens out. And as such, Lawler, he expects that EV prices will equalize with gas prices. He also said that fewer than half of sales will be EVs by 2030. Now, GM also dealing with that stalling EV push. That's a production story as well as a demand story for GM. Trouble at its battery pack facilities has kept EV production in the low thousands. You think about how many cars Tesla sells, and there is a lot of gulf there. GM's Mary Barra said yesterday that GM should have those issues fixed by mid-2024. And that timetable is important given that EVs, they're a big piece of GM's strategy to double sales by 2030. So we'll see how that works out, John. I will just say, though, that range anxiety is real.
It's a real thing. It's a big deal. Ed Ludlow, Tesla seem to be doing okay, though. And I just wonder if they're still in the driving seat after these additional costs come through for GM and for Ford.
Yeah, they've kind of continued to extend the gap as the market incumbent in electric vehicles, despite all the chat for 4 years, basically, or probably going back to 2019. that legacy auto would catch them up. It's why the Cybertruck event today is so significant. You know, I remember being there in Los Angeles 2019 when this edgy Cybertruck rolls on stage, no one in the room really believing that's it, and Musk, in classic style, promised that he would change the pickup category. Yes, he's behind his own timeline and schedule, which is pretty common for him. But this is a really ambitious product, and it's one where you look outside the traditional barometers of demand, look to social media, look to the commentary, the image sharing, and there's a lot of excitement around this. It's going to be low volume at first, and there's been brilliant coverage by my colleague Dana Hole on how Tesla has once again started with the technologically most challenging version of a pickup truck and plans to ramp it slowly. Musk said 250,000 units maybe by 2025. It's going to be incredibly difficult because of its complexity and the materials with which it's made. The pickup is sacred in North America, John, as you know. Yeah. And it's going to be interesting to see how big a dent this makes into the big legacy OEMs.
Big day for the company. Ed, thank you. Ed Ludlow there alongside Katie Greifeld. Priya Misra, Krishna Mamani back with us for some final thoughts. Let's build on what we were talking about, disinflation, the auto sector cutting prices, Walmart only a few weeks ago talking about deflation in the pipeline. Priya, Goldman Sachs in their outlook for next year said the hard part was over. Is the hard part over, or is that still in front of us?
I think the hard part of getting inflation from 5% to 3%, I think that's over. I think the hard part is upon us now on the growth front, because does this immaculate disinflation, getting that inflation from 3% to 2%, getting wages down with a tight labor market, I think that's where, with the lags coming in, you know, you're seeing cracks in the consumer balance sheet sort of starting to pick up with more credit, credit card build-up, with higher delinquencies. I think that hard part is upon us, which I think the market's not priced in at all. You know, I think we're in the soft landing, the market's pricing in that soft landing. So when you talk about the hard part, I think, can the economy withstand and bring inflation back down to 2%? Keeping growth where it is, or does growth start to falter? And at that point, I would argue every hard landing starts looking like a soft landing first. Yeah. You know, is that the risk that growth slowing stalls here, or does that just continue to accelerate? Recessions are always nonlinear.
These are the questions your colleagues in the investment bank are asking as well. JP Morgan on the investment banking side of things in the research team, 4,200 price target. Krishna on the S&P 500 with a downside bias. Part of that call to what Priya is talking about, the market is assuming a near perfect landing with inflation cooling without a significant impact to demand and pricing power. Krishna, can those dreams be realized?
So I would kind of respond to what Priya was saying, that every soft landing looks like a soft landing as well. The point is, things are moving in that direction, and we really have no data point other than pure conjecture to speculate that that won't come about. And I think the other key point to remember in that regard is the fact that the one thing that Fed is far more focused on right now than it was in, let's say, 21, 22, when they were dealing with a real big-time inflation issue, is they don't want to extract, a loss from the jaws of victory. That is, they have done a lot, and they cannot afford, I think, from their credibility standpoint, to continue to overdo it and get the economy in a recession. So I think when the data gets slightly muddled up, they are probably cutting rather than not cutting.
Krishna, appreciate your thoughts. Fantastic panel this morning alongside Priya Misra, Krishna Mamani. Coming up on this program, the morning calls and later, Citi Stuart Kaiser making a case for another year led by big tech. But, and it's a big but, he thinks this rally is built on good data, and when that data starts to turn, you should turn away as well and run. That conversation up next, your opening bell, 7 minutes away.
adults are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Slice through the noise. Forget the noise. Ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point, what is the lesson or the observation?
We are about 5 minutes out from the opening bell. Good morning to you. Equities doing okay on the S&P 500, positive here by about 0.2%. Going into that opening bell, let's get you some morning calls. Your first one coming from the team over at Jefferies. Upgrading Pinterest to buy $41 price target, seeing catalysts for upside revenue growth next year. That stock is up by 2.2%. The second call from Wolf Research, upgrading Ali Financial to outperform, expecting the company to benefit regardless of the economic environment, positive there by 2%. And finally, Morgan Stanley, upgrading HP Enterprise to equal weight, pointing to an attractive valuation and upcoming opportunities within AI. That stock is positive as well by almost 2%. Coming up, Citi's Stuart Kaiser expecting another big year for big tech after a monster month for the NASDAQ. That conversation up next. Your opening bell just around the corner.
Thing in life I've often said is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
DOJ or other authorities
Could face big
bigger challenge.
Listens next.
It was going to keep rating World Cup. This is a 3.
As the economic picture does.
The OK is getting ready to make.
The last trading day of the month. Favorite quote of November. Jack Caffrey, JP Morgan. What a year this month has been. What a year this month has been. On the NASDAQ, double-digit percentage point gains on the NASDAQ 100 of something like 11%. Right now, just about unchanged on the NASDAQ, just about unchanged on the S&P 500. The equity market bulls want November to go on forever. There's your opening bow. Switch to the board and get to the bond market. Yields look like this on a 10-year. This morning, higher by 6 basis points. On the month, down by something like 60. Down something like 60 basis points and down something like 70 from the highs of October 19th, where we were looking at 5% on a 10-year yield. In the FX market, the euro, 109.15. We're negative on a session by 0.5%, but the euro on the month heading towards the best month of the year, just like the equity market. The dollar a whole lot weaker, worst month of the year for the dollar. The euro on the month up by about 3%. Incidentally, the best month for euro dollar if we close like this going back to November of last year. Elsewhere in the commodity market, we'll be talking about OPEC Plus in just a moment, up by 1.4%. WTI crude just south of 79, 78.93. About 45 seconds into this session, we're positive by 0.1% on the S&P 500. The NASDAQ up by 0.06%. One stock to watch at the open, Salesforce. Cost-cutting measures helping the company deliver better results. Abby has this one. Hey, Abby.
Hey, John. Yes, and investors are really liking these results. The stock right now is having its best day since March of this year, really cheering what is considered also to be a low bar quarter that the results beat specifically across the board. But it was mainly profits, adjusted earnings by 19%. They put up $1.38 in adjusted earnings. They also raised the profit range, the outlook, but you just mentioned the cost-cutting efforts. In August, they cut jobs. That followed a 10% staff reduction earlier this year. The goal was profitability. They achieved it, revenue beating, but just very slightly. Now, one part of the raised outlook is being called better than feared by Morgan Stanley, but Morgan Stanley is also questioning to some degree Gen AI, their strategy into 2025. So again, this is a better than feared result because the stock is still down about 20% from its 2021 peak, even though it's up 73% on the year. And that declined from the peak, John, even with today's pop.
Abby, thanks for that. Let's turn to the autos, shall we? Ford lowering its profit outlook due to rising labor costs for UAW staffers. Simone Foxman on top of this one. Hey, Simone.
Hey, John, your shares higher, but not by too much in early trading. For profits for 2023, the company now looking at $10 to $10.5 billion. It had seen $11 to $12 billion as recently as July, but remember that Ford's suspending its guidance in October in the midst of that UAW strike. Citi calling this encouraging, saying the company is tracking towards the higher end of its guidance before the strike. But of course, those labor costs going to come into play. And we got some word of how these labor costs are going to play out over the 4+ years of this UAW contract. They're going to cost the company $8.8 billion over its duration, translating into $900 a car. And John, now I know you brought this up with the Ford CFO this morning, especially comparing to the $575 a car that GM said it will see yesterday. Ford, of course, going to try and mitigate this through cost cuts, productivity increases, but you know, the comparison to GM is really there, and that's why we're seeing shares actually now lower. Remember, we saw a huge surge in shares in GM yesterday when it reinstated its 2023 guidance, so we're moving in the opposite direction.
It's kind of bizarre. Of course, Simone, the one thing we didn't get from Ford this morning that we did get from GM was just a monster buyback, but forgive the pun, you could drive a truck through the guidance, the difference between what you heard from GM and what you heard from Ford, which makes you wonder, and I was thinking this morning, is one being a whole lot more transparent or conservative about how much this is going to cost than the other? Simone, thank you. Lots of attention on something else this morning. Elon Musk, the owner of X, and a whole lot more, dropping some choice words for advertisers. Ed Ludlow has this one. Hey, Ed.
Good morning, Jonathan. There was an apology on stage from Elon Musk at the New York Times Deal Book Conference for that November 15 post. He added that it was the worst and dumbest I've ever done, quote, in reference to that post, which at the time was seen to amplify the anti-Semitic views of another user. Elon Musk did push back and said that he, at the time, had quickly clarified what he meant in a longer form series of posts that the media ignored. The main takeaway is that in an expletive-laden answer, he basically said that he was disinterested, and I'm paraphrasing, John, as I'm sure you can appreciate.
Sure, yeah.
The advertiser flight that we've seen on the platform. He called out Bob Iger. Well, we believe he called out Bob Iger, saying, "Hey, Bob, I'm sure you're in the audience somewhere," in reference to Disney's CEO. But, you know, the idea and what I'm hearing from people inside X, the platform and company formerly known as Twitter, is that this is Elon Musk putting the principles of the company above money, above profits. And you will note the post that X's CEO Linda Yaccarino made after Musk's appearance, saying, and indeed calling it, this was an apology and set out what X really feels about the situation. And again, a reiteration from Musk, he is in no way anti-Semitic.
Ed, I thought 60 seconds later was a lot more interesting, and I'll tell you why. 60 seconds later was more interesting because he started to say that advertisers, and he alluded to this, he didn't say it explicitly in quite the same way, but he basically said that advertisers in corporate America seem to be more interested with the perception of doing good and not people who are doing good, and talked about the success of Tesla and his leadership there. This leaves Disney in a really, really interesting position. Ed, what's the next move from them and Bob Iger?
Yeah.
How do they respond to this?
I mean, what X would say in response to that is that even though they're not doing paid advertising, a number of those companies that have been reported to have put their advertising campaigns on hold are still posting to the platform for free. So there's a double standard there. You know, the lead in our story is that Musk is sort of taking a moral high ground where he's saying that it will be the advertisers that kill X, but the world will know that they're doing it because he is doing his own action and behavior out in the open. Again, for our Bloomberg audience, remember the debt. Remember the debt that is sitting with the banks that underwrote this deal that they can't package and sell to the asset managers because there are no buyers right now. Tesla is down another percentage point today. It fell 1% yesterday. I'm not drawing a causal link, but Tesla has traded as a proxy for sentiment towards Elon Musk's words and actions more broadly, even if it hasn't been in conjunction with the EV maker and has been in conjunction with some of his other companies.
Ed, got it. Thank you, mate. Appreciate it. Just going through some breaking news. Let's get straight to it. From OPEC Plus, according to a delegate, I'll go through the headlines. Manus Cranney is going to join us in about 10 minutes' time and go a little bit deeper for you. So there has been an agreement, according to a delegate. They've agreed on 1 million barrels a day of extra supply cuts. There's a key line alongside this, that those extra OPEC Plus curbs come alongside the extension of Saudi cuts as well. So let's push that through the commodity market and take a look at crude, WTI and Brent. Crude right now, WTI just pushing about 80 at 79.35, up by 1.9%. Brent crude up to about 84, up by 1.5%, getting closer to 80 on WTI. Going to return to that story in just a moment, so let that sit there just for a second and turn back to earnings. Kroger delivering a cautious outlook. Katie Greifeld has the story. Hey, Katie.
It's an earnings story we know well at this point. The third quarter, it was all right, but it was the guidance that was a little bit disappointing here. Specifically, you take a look at Kroger's third quarter adjusted EPS. That came in at 95 cents. The estimate had been for 91 cents. You also had sales a touch better than expected. But then you look ahead, Kroger's, it did narrow its adjusted EPS range, but the upper end is still the same. And the grocery chain also lowered its guidance for full year same-store sales to a range of 0.6% to 1%. In September, that range had been between 1% to 2%. And one of the reasons why they are so cautious is because it was the impact of near-term economic pressures and food-at-home disinflation. That's a new phrase for me. So that's not necessarily good news for Kroger's margins, and you can see that disappointment working its way through the shares a little bit here, down 0.4% and lower by about 3% on the year, John.
Katie, thank you. Thanks for the update. Let's get you an outlook. Stuart Kaiser of Citi weighing in on the month ahead for stocks, saying this: catalysts will matter, particularly US CPI and an upcoming Fed rate decision. We remain constructive while favouring the Qs and continue to expect a rally through to year end. Stuart, I'm pleased to say, joins us right now. Stuart, good to catch up, as always. You've said for a while, and we've been talking about it, you've said this rally has been built on good data. And when that data turns, you'll be running in a different direction. Stuart, can you tell me whether that data is starting to turn?
Hey, good morning, Jonathan. No, it doesn't really appear so. I mean, you saw GDP yesterday got revised higher, core PCE got revised lower. You know, our economists expect about 200K of jobs next week. So, I mean, the economic data continues to come in pretty well. You know, Abby used the term before, better than feared, and I think that's how you describe probably the first half of this year. The question is, I think, will better than expected data, you know, still help us? And the reason I say that is our economic surprise indexes are still positive, but they've really started to trend lower the last 3 or 4 weeks. So that's probably a combination of the data not being, you know, completely blowout data, but also expectations rising a bit. So, you know, in our view, the data still remains strong. It still means you want to run long equity, but probably the risk reward around that data is not quite what it was a few months ago.
Stuart, how big do you think that window is? And I hate to ask those time questions, so forgive me, but how big do you think that window is to still be constructive?
I mean, for us, it's at least through year end and probably into early next year. You know, our U.S. economists still have a recession in next year starting in 2Q, right? So if you're going to, you know, get into recessionary conditions in 2Q, then, you know, intuitively in 1Q, you should start to see some weakness in the labor market, right? So that's really what we're going to be focused on. It's payrolls, it's claims, it's credit card spending and credit card delinquency. And in our view, as long as that data holds in, you want to be running long equity risk. As you mentioned, if it weakens, you want to get out quick. So I think, you know, definitely first quarter next year, we're going to be on guard just based on the timing of the recession our economists have.
Let's talk about how you want to be long equity risk. Are the winners of the year going to be the winners of the month next month?
That's our view. I mean, we the last month, you know, obviously a very strong return, S&P up, you know, 7.5%, but tech is outperformed by, call it 325 basis points over that time. You know, we don't think PMs are really going to step out of the comfort zone in the last month of the year, so we would expect what's worked this year, which has been kind of large cap tech and growth, to continue to work. Early 24 is a much different discussion, but at least tactically, we still like that kind of tech trade into year end.
When you say turn and move in the other direction once the data starts to turn, Stuart, we know what you're going to move away from. What are you moving towards?
Cash? No, it's a great question. I think, look, if you were to get a weakening of data, I think what you're looking at is the more defensive and rate-sensitive parts of the market that have underperformed, you know, significantly this year, right? So that's going to be your utilities, your staples, your real estate. You look at something like consumer staples, it's down, call it 5% this year. It would benefit from a rotation into defensive areas of the market, and it would benefit if rate expectations started to decline, you know, alongside slower growth data. So I think if you're staying within equities, you're staying in high quality stocks, you're probably buying some of those defensives that have lagged, and you're just going to kind of batten down the hatches for a bit and see how that data plays out.
You and I are having quite a short-term tactical conversation, and that speaks to the seat that you're currently sitting in, Stuart. I just wonder if we can push the timeline out just a touch. There are a lot of year-end price targets out there. This came from JP Morgan in the last 24 hours, 4,200, downside bias. This line stands out. Valuation is rich. The market is assuming a near-perfect landing with inflation cooling without a significant impact to demand and pricing power. Stuart, is that the bet that you sense is currently priced in this market?
No, I don't think the average investor is quite that negative on the market, and really they've been beaten into that view by very strong economic data. You know, I mean, definitely understand the logic. You've done a lot of rate hikes, and people are waiting for the next shoe to drop, and assuming that you can't get inflation lower without a significant hit to demand. So, look, I definitely understand that. I don't think that's the base case view for most investors right now. But look, as you mentioned, if you get some weak economic data, the base case view will shift pretty quickly. But, you know, our forecast has, you know, a relatively mild recession in the middle of the year. We have almost $245 of S&P 500 earnings next year, which would be, you know, call it, you know, high single digits to low double digits growth. So that would probably set up for a slightly more constructive outlook, you know, than the one you've described. You know, to me, the more important thing is within our earnings forecast is a broadening out of the earnings base. So it's not coming from 2 or 3 sectors. It's coming from a lot more sectors. And in theory, that should also drive broader leadership of the market. And that'll be something that we really want to take a close look at as 2024 approaches.
Stuart, you know, price changes narratives pretty quickly. That's been the experience of the last month, hasn't it? It's good to catch up, buddy, as always. Stuart Kaiser there of Citi. Just how price has changed narrative. Go back to October. So here we are, October 23rd. We top out on a 10-year yield of 5.0187%. October 19th, back about a week or so. We top out on a 2-year of 525.71. And here we are this morning, 469 on 2s, on a 10-year, 433. Not much has changed in the last month, and yet the conversation has changed radically compared to the data. Look at these moves now. 2-year yield up another 5 basis points, 10-year up around 9, on the session at least. I want to turn to crude. Crude looks like this in the commodity market right now. We've got a bit of a rally for you on WTI and on Brent as well. Off the back of this decision from OPEC, I've got WTI at the moment on my screen to $79 through that level. Brent crude at about 84.27. Coming up, crude rallying as OPEC agrees on deeper production cuts.
The lesson of 2022 and early 2023 was that we cannot control what happens in the rest of the world, especially as it pertains to the supply of oil, the supply of natural gas.
The latest developments up next.
Do you see a future for Monumental as a public company?
Yeah, I think so. I think what we found is the leagues have opened up to new pools of capital. Over the last year or two, both the NBA and NHL have allowed professional investors to come in, not as individual owners, but as funds. So that's a whole new pool of capital that didn't exist before. Sort of shows a whole new asset class opening up for professional sports, not just teams, but professional sports enterprises.
I think the sophisticated analysts will be looking at this industry, and as our revenues start to get in the billions of dollars, yeah, I think that you'll see a wave of companies go public. Whether we will or not, there's a big responsibility when you're a public company. And I tell people, we're a public company already. The scrutiny that you're under in running a sports team is, I think, much higher than a public company CEO has to live with. We'd be prepared to do it. Just the market would have to be right. We'd have to emotionally be ready to do something like that. But I think Monumental will be one of the 3, 4, 5 best-in-class organizations that, if that time was there, sure, we could go public.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on that folks are so excited about it. Climate tech is the hottest area to be in.
Breaking news from OPEC Plus. Let's get straight to it. Manus Cranny standing by. Morning, Manus.
Jonathan, very good day to you. Yeah, it looks as if it was the much hyped extra cuts are to come through. OPEC Plus agrees to a 1 million barrel a day of extra supply cuts. It's critically important to understand you have unilateral cuts by Saudi Arabia and by Russia. So the lollipop, as Prince Abdulaziz bin Salman refers to it, is the 1 million barrels of cuts by Saudi Arabia. This is an extra million. It's how does it get distributed? This is about pushing back against the speculators. This is about pushing the market towards deficits in the first quarter of 2024, which they have failed to deliver in the fourth quarter of this year. How will it come down the pike? Just looking at some of the assumptions, talking to Rapid Energy on WhatsApp at the moment. By our math, the rollover into the first quarter could push us into a deficit of around 500,000 barrels. But of course, this is to try and push back against what's called the contango formation in the market. How does it split down? Looks like the Emiratis may well, we need the details on this, they may well still get a bump in their quota. But we look at the African nations, that's where the critical important points in this extra million and the breakdown. We're waiting for that to come through. Jonathan.
Manus Cranny, thank you, sir. Let's continue this conversation. JP Morgan's Christian Malik joins us now out of Europe in London. Christian, your first reaction to this, you were looking for cuts. Let's deal with size first. Is this the number you were looking for?
Absolutely. In fact, the way I look at this is the Saudi lollipop has become the OPEC lollipop. And I think in that vein, what's important here is that all of OPEC has recognized that speculators are not conducive to stability in investment, and therefore controlling that price, making it conducive within a range that's healthy is the key. I know we're looking at deficits. I'd sort of say they're not trying to force a deficit. They're not trying to force the price higher. What they're trying to do is protect the price in a range that's healthy for everybody.
Can you talk to me about distribution? Just how important is that just in terms of price? Does it matter at all?
In terms of distribution of the cuts, I mean, I think ultimately what Saudi's done is led by example. Prince Abdulaziz is a great negotiator, and I think the whole of OPEC has now, I think a milestone has been achieved here, right? So first of all, the baselines, this has been 2 years in the making. The exam results are out, and everyone's abiding. Let's see where it all falls. But then to get the baselines right is critical to then understanding the quota, the compliance, and what that actually means. There's no point having quotas when the baselines are wrong. So I think the milestone here isn't necessarily just the 1 million barrel extra cut that we called for 3 weeks ago. The milestone here is that everyone's on the same page in terms of accountability, which if you're trying to be the central bank of energy, that is key.
Let's think about next year and what's on the table right now. So this morning what we get is some better visibility on the future of supply. Then you've got to think about what the demand picture looks like. Based on that, going into next year, is this the deficit that you're looking for?
I think so. In fact, actually, it's more than that. What they're trying to do is preempt, de-risk any potential downside to demand. Demand's going to be okay next year. I think there's been a huge amount of concern around demand. We see it around about 1 million barrels a day of growth. Actually, what's more important is what happens if we see, a car crash in terms of a COVID unwind, in terms of all those cash savings become negative for demand all of a sudden in Q2, Q3. What happens if we see a little bit more volume from GOM, from Brazil, from shale? In that scenario, this cut is key. Now, so in some ways, it's not just mitigating potential demand risk to the downside, it's also mitigating any potential surprises to the upside, particularly in Venezuela, Iran, and Libya, where we've seen more volume than we necessarily expected. So this is about fine-tuning as opposed to some massive preemptive strike on something major that's going to go wrong. Fine-tuning, I think, is the key theme here.
So let's put a bow on it. Right now, WTI, 78, Brent crude, 84. You've got some price targets. What kind of numbers are you thinking about next year?
I think a range of 70 to 90, particularly given my comments around the surpluses that we could see, is probably the right starting point with upside risk towards 100. I think a really key here, John, is not just necessarily how we think of next year. Think of next year as sort of transition year into major tightness in 25 and beyond. So as long as we can hold the rails in 24, particularly with these surprises on both supply and demand, we're now entering into sort of the safe zone in 25 plus. Why? Because we don't see major quantums of volumes coming from shale or outside in terms of non-OPEC, non-US. And I think this is important because what I've sensed from talking to investors is people think OPEC is sort of on the weak side, so they're sort of on the back foot. If anything, all they're doing is consolidating market share in the medium term, because as we go into 25 and those deficits really start to bite, that's when they decide what to add and by when, and that's when they rein in full control of the range that they're looking to solve for.
You're a deep thinker. Always enjoy catching up with you. Christian Malik there of JP Morgan. Thank you, sir, out of London this morning on the latest decision from OPEC Plus, another big cut. About 23 minutes into the session, let's get you some movers, some sector price action. Here's Abby.
Well, we do have the sectors nearly evenly split. Since there's 11, there can't be, but at this point we have 6 to the upside, led by energy on oil's rally on the OPEC Plus cuts. We also have financials, materials higher to the downside, staples down 0.4%, discretionary discretionary and services. Let's look at the month, though, John, because it's a banner month. As you know, the S&P 500 heading to its best month since July. That has a lot to do with technology being up 12.8%. But the sector I really want to focus on, real estate, up 11.3%. That is the best month for real estate going back to 2011, having to do with rates down.
Avi, thank you. We'll take another look at the calendar the rest of the week. Up next, your trading diary, just around the corner.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip. A bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
This is Bloomberg.
November, just absolutely amazing. One more month to go after today. Your equity market just about positive, about 25, 26 minutes into the session. Positive here by 0.1%. That's the price action. Here's the trading diary, the calendar into the weekend. ISM manufacturing numbers coming up on Friday, plus Fed Chair Jay Powell headlining a busy day of Fed speak. That includes Barr, Goolsbee, and Cook. Looking on to next week, Tuesday, we get JOLTS data. Wednesday, US bank CEOs testifying before the Senate. And then next Friday, the payrolls report, a week tomorrow. From New York City, that does it for me. Thank you very much for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
News breaks. No one covers the world like Bloomberg.
On the AI question, what we don't really see is Apple doing a knee-jerk response and moving into the domain of generative AI.
Supporters of President Recep Tayyip Erdogan celebrating late into the night, dancing and singing.
We have a fundamental reassessment of everybody's capacity within OPEC. Should we talk about $95 and $100 oil again? Not for a while.
Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Thursday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Coming up, we're going to check in with Bloomberg's David Weston to get his thoughts and perspective on the extraordinary life of Henry Kissinger, who recently just passed away at the age of 100. Then we're going to talk some technology with Dan Ives, senior equity analyst at Wedbush Securities. Talk to him about this Tesla. The Cybertruck is out. What does it mean for the company and the stock? And then we're going to talk a little real estate here. Lisa Sturtevant, chief economist at Bright MLS, is going to join us to discuss real estate data and the outlook for the sector and mortgage interest rates. So they're high, but they're starting to come down. All right, let's kick this whole thing off as we tend to do with Mr. John Tucker with the Bloomberg Business Watch.
All right, Paul, major averages right now, call it mixed. They've turned around. Energy, best performing major industry group in the S&P 500 as OPEC Plus agrees to oil production cuts. That's the thing that sent some of the stocks lower. Dow component, Chevron, though, that's up close to 1%. Also, we had data this morning showing the Fed's inflation fight. It appears to be on track. But bond yields, kind of counterintuitively, they're pushing higher right now. Meantime, Stephen Whiting at Citigroup Private Bank says, look for more stocks to join the rally.
We think that a broadening equity market is the way that we will see the markets in 2024. It's not that we're going to get another 18-19% gain in the S&P 500, but most stocks will be looking forward to a broader earnings recovery.
And right now, the 10-year yield, 8 basis points higher, 433. The 2-year up 5 basis points at 470. S&P 500 down 2 points, 45.48. Dow Jones Industrial Average up 238 points right now. The NASDAQ 100, 92 points lower. That is down about 0.6%. And because you're going to talk about this, Tesla shares will do that. That is right now the most active, down 1.3%. Something tells me you don't like the new Tesla Cybertruck.
I just don't get it. What's not a truck?
Doesn't it look like a DeLorean?
Yes, exactly. We need Matt Miller here for maybe he can phone it in and tell us what we should be focusing on there.
Yeah. whatever.
John Tucker, thank you so much. We appreciate it. So, we'll see how that goes. All right. Molly Smith sitting in for the aforementioned Matt Miller, who was on paternity leave. How are you doing, Molly?
I'm great, and I'm so sorry I don't bring the same car knowledge as Matt
Nobody
to the
does.
discussion.
Nobody does, and that's why he has a podcast with, a whole bunch of crazy car people as well. So it's a great stuff. Check that out, Matt Miller's podcast with Hannah Elliott. Molly Smith, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well, so you can head over to youtube.com. I'm told that's the internet, and search Bloomberg Radio, and that's where you'll find us. Boy, we started out, the futures were ripping this morning, but now we're kind of mixed here. S&P kind of unched on the day. Let's check in with Bailey Lipschultz. It's his job to focus on these markets. Bailey, what do you got to say for yourself?
No, the data seemed like we were setting up for a strong leg higher, but it does seem like, Paul, we're running into a bit of that buyer's fatigue, if you will. Earnings season, though, continuing to roll on. Best performer in the S&P and the Dow. Salesforce, as JT mentioned, right now up 7.5%, ticker CRM, trading at the highest since January 2022, beating expectations, raising their profit outlook. This is one of the many companies that had been cutting jobs to tighten spending, and that does seem to be playing out. Another company that is ripping this morning after results is Snowflake, ticker SNOW, right now up 6.1%, trading at its highest since July. That coming as earnings beat, third quarter earnings beat, showing signs of stabilization. One of the things analysts were calling out was there was a 3-week stretch that was one of the strongest seasonal stretches for the company in quite some time. So that's why you're seeing those two rallying. And anytime there's a biotech deal, I have to mention it. So AbbVie acquiring Immunogen. $10.1 billion, almost 100% premium. AbbVie is one stock to keep an eye on. This is a company that Humira, their biggest drug, one of the best-selling drugs over the last few years, hitting a patent cliff next year. So trying to bridge that gap, trying to backfill some of those sales going forward. That's why you got Immunogen ripping and AbbVie maybe a bit on the trade, but down kind of on the margin.
And what do I do when I see an M&A trade? I go to MAGO and see who's getting paid, which of my buddies are getting paid here. On the acquirer side, JP Morgan and Morgan Stanley, boom. On the sell side, Goldman Sachs and Lazard. So no little boutiques. These are big-time M&A players, so they're getting paid today. I tell you, when I come back in the next life, it's either as a private credit dude or a big pharma M&A banker.
Well, we've talked, though, about lawyers make some pretty good cash.
Yeah, but okay, here's my lawyer story. When I was like a lowly analyst, we'd be drafting documents for like some bond deal. Who cares? The bankers, we'd leave at 10 o'clock and go out and get a couple cocktails. We'd come back in the next morning at like 9 o'clock, and on our desk would be the marked up documents faxed over with a timestamp of like 4 a.m. So my boys, they stayed there another 6 hours while we were safe in our beds. Not a place to be.
Not a radio host either.
No, exactly.
Okay.
Yeah, 4 hours
Too
a day is
bad.
plenty.
Do get to bill by the hour, though.
I know, they do. But my buddy, Bob Z, he's the senior dude of Paul Weiss. He's still billing by the hour. It's just a grind. It's no way to live your life. What else you got?
Well, we're keeping an eye on a couple other companies. Ford right now down 1.2%, lowering its profit guidance. This coming after GM rallied yesterday, 9.4% rally yesterday for GM. So a bit of a bifurcation that we're seeing as these automakers kind of take into account the labor costs from the new contract with the United Auto Workers Union. So keeping an eye on car makers ahead of the Tesla Cybertruck announcement, unveiling, handing over the keys. I don't know. As you mentioned, I don't know if the photos on X are real, but if you can't fit a bicycle in a truck bed, you can't call it a truck.
Or a bale of hay on my ranch.
That's the standard. Can't fit a bike.
All right, Bailey Lipschultz, thanks so much for joining us. Bailey Lipschultz, he covers the markets for Bloomberg's News, giving us up to date on this market here. We want to bring in Bloomberg TV's David Weston for a conversation on the life and legacy of Henry Kissinger. But first, we want to bring you part of David's discussion with Bloomberg opinion columnist Neil Ferguson, who wrote a book on the life of Henry Kissinger and spent extensive time with him. Here's part of their discussion on the role of Kissinger played in the Yom Kippur War.
For Kissinger, the moral imperative in the Cold War was to avoid World War III. And that was one of the reasons that he pursued a policy of détente, of understanding, of improving relations with the Soviet Union, because I think reasonably he thought the worst possible outcome for the world would be a hot war between two nuclear-armed superpowers. And so in practice, when he entered the realm of power as Richard Nixon's national security advisor, I think he remained an idealist, but an idealist who was having to deal with some extremely difficult choices between, as I've said, greater and lesser evils. So I don't think the idealism was ever entirely eradicated. Certainly working with Richard Nixon, you were working with somebody who saw himself as a very tough realist, who wasn't afraid to do very difficult and even nasty things. So I think there was an element of compromise just in accepting a job with Nixon. But once Nixon has gone, it's very interesting to see Kissinger under Ford shift in a much more idealistic direction. And a lot of Kissinger's later career, about which one hears much, much less, owed a lot more to his earlier roots in German idealism.
That was Bloomberg Television's David Weston speaking with Bloomberg opinion columnist Neil Ferguson. I want to bring in David Weston right now. David, thanks so much for joining us here in our Bloomberg studio here. What a life. It's been your life, my life. That has been U.S. diplomacy, whether it's official or non-official. It's been Henry Kissinger.
Yeah, he's been the only diplomat I'd ever heard of, frankly. I mean, when he first appointed, I was in high school, actually. Yep. I'm old enough to remember that when Richard Nixon appointed him. But, and as Ray Dalio actually just posted something saying this, you can't think of anybody who studied history as deeply as Henry Kissinger did. As an academic at Harvard, he would have had a distinguished career in that, and then lived the diplomacy and was responsible for it, and then got to know pretty much every world leader, and didn't just know them, they hung on his every word. And that's China, that's Soviet Union, that's Anwar Sadat, and Egypt, around the world. I mean, it's quite extraordinary. If you read his book on leadership, he goes through the 6 leaders that he had respect for. He starts with Charles de Gaulle, whom he knew personally. And he goes on to Konrad Adenauer, whom he knew personally, and Maggie Thatcher and things. It's really an extraordinary life.
Wow.
And David, you knew him personally as well. So maybe if you could tell us a little bit about some of your memories with Henry Kissinger and what you'll think of him most.
Yeah, I would say, I'm not sure Henry would say this if he were here, but he sort of adopted me when I came to New York in the mid-90s. Wow. I think he took pity on me and took me under his wing. And he used to invite me to breakfast that he had with like 20 people or so at a club where he'd have visiting dignitaries in, people he'd known through the years, where we'd have an off-the-record discussion about what was going on in Asia, in Europe, in the Middle East. And it was wonderful. It was a wonderful experience. And so he really, and I had lunches with him where he was a teacher forever, and he wanted to teach you, and he had an amazing mind. You could agree with him, you could disagree with him, but he had thought it all through many times, and he could explain to you how everything was connected to everything else. It was utterly fascinating. Last thing, he was a huge dog person.
Really?
He and Nancy loved dogs. I mean, you can't believe they always were with a dog constantly. And he was a charming, actually very warm man in many ways.
It's amazing. What did he think of what's happened, not just in the United States over the last 5, 6, 7 years in terms of the nationalism, America first in the U.S., but Brexit in the UK and the elections. It seems like internationalism, which I think you and I kind of grew up with post-World War II, is not necessarily the leading role or the leading thought here in international relations these days.
Well, these are my words, not his, but I think he would say it's dangerous. We have to remember, he came out of Nazi Germany, fleeing it in 1938 with his family as a Jew. And he studied in his work, he started with post-Napoleonic Wars, putting together Europe and talking about the balance of power with people like Metternich, that he really valued as a way to avoid war. He wanted to avoid conflict at all costs. And I think he would say, if we were here today, there are real dangers in everybody going to their respective corners and fighting one another. People get hurt that way. And in fact, he talked about this just last month, was the last time I saw him. He appeared live at the Al Smith dinner here in New York. And he gave a speech on this very subject, warning people about the dangers here that we have in front of us if we keep going this way.
Well, one of the bigger parts of his legacy was, of course, brokering the peace in the Middle East, and it certainly harkens now to what we're seeing between the war in Israel and with Hamas. So did you speak to him more recently to know what he was thinking as far as the conflict now, or what you might imagine he would have to say thinking about this current conflict?
Yeah, I don't want to be so presumptuous as to speak with him for him, but I think he would definitely say it's very different in many respects. The attack was different. Hamas terrorists going in and slaughtering children was different from a surprise attack from Egypt and Syria into Israel. At the same time, there are some parallels because what happened there, if you remember, is Henry Kissinger with President Nixon came in strong on the side of Israel and shifted them a lot of weapons and material and support in the United States. But then there was a pivot where they started saying, Israel, you got to back off. You can't go too hard against Egypt. And in fact, at one point, he really intervened very forcefully because he was concerned that if Israel tried to destroy one of the armies of Egypt, which they could have done, that the Soviet Union would come in and there'd be a shooting war, and we'd end up with U.S. against the Soviet Union. So he actually played a key role in saying to Israel, you've got to back down. And he had some real conflicts with Golda Meir at the time.
Yeah, and of course, Israel is getting different pressure now to back down, not for fear of Russia coming into the conflict, but kind of similar to what we're seeing now in that sense.
David, some of the criticism of Mr. Kissinger, maybe as it relates to human rights and his pursuit of global diplomacy, what he would say, what I've read, I'm making some hard choices here, and some of the hard choices might result in some human rights being violated in various places around the world. How did he deal with that, or how did he talk about that?
Well, he did talk about it, and I would say he would deny this. I would say he was a bit defensive, particularly about things like Cambodia.
Right. But
you can't talk about the legacy of Henry Kissinger without talking about some of the controversy with Cambodia and the so-called secret war, with what happened in Chile with the coup, what happened in Argentina, and even what happened in Pakistan. But I think, and Walter Isaacson also wrote a book about Henry Kissinger, quotes Henry, quoting a version of Goethe that basically said, if you make me choose between injustice and order and justice and disorder, I will take injustice and order. I think which comes partly from his background, because he saw what disorder in World War II in Europe could do. And so he did make some tough decisions. I'm sure he would say there's such, and he would say, look, I can't say I was right. I just, tell me what would have been better. Give me what the better alternative would have been. At the time, that was the one that would preserve the most order that we could have.
When we're thinking back now to the war that we're seeing in the Middle East, and current Secretary of State Antony Blinken, he's gone out to Israel to speak with the officials over there. Do you think that there would, speaking onto how you think that the current Secretary of State can really, what their role is in this conflict and how it's different from Kissinger's role back at the Camp David Accords?
Yeah, ironic, isn't it, that we're seeing shuttle diplomacy, even as we speak right now, with Tony Blinken over there, Israel, and going to Ramallah, going to the West Bank, and trying to keep things under control as much as they can. It's ironic. It's very difficult because, for those of us who are around, Henry Kissinger was larger than life. He dated superstar models and things like that, and he was on the front page of the paper all the time, and he had such a powerful position at Nixon. I'm not sure there are figures anywhere right now that loom as large, but I think what we're seeing from Secretary of State Blinken and from President Biden right now is a version of what Henry Kissinger tried to pursue, which is basically, let's talk to all the parties, figure out where the interests are, find the right balance, and keep things under control. Even if we can't come to an overall solution to the problem, let's manage the problem and try to minimize the damage and, yes, the loss of human life.
David, Mr. Kissinger was one of the architects of détente with the Soviet Union. What were some of his thoughts about the rise of Vladimir Putin and kind of what we're seeing from Russian activities over the last decade or so?
Well, he obviously, I suppose, thought that that was very dangerous and very risky, and a much different situation to what we've had before, in part because actually Russia today is not as powerful as the Soviet Union was then. If we think back to that Cold War, there were two superpowers that were squaring off. If there are two superpowers today, it's China and the United States. And Russia is a smaller player, which in some ways makes it more dangerous. Because they feel they have less to lose, and they feel that they have more to gain. And certainly if you read what Vladimir Putin says, he feels he was really done wrong. Russia was done wrong with the fall of the wall, and he's got to restore that prestige, which makes it more dangerous.
China, that's the new thing that, I can't imagine he's very happy with what's kind of chilled over a relationship over the last 4, 5, 6 years between U.S. and China.
Well, perhaps his last international trip was to Beijing.
Very good.
Where he got to meet with President Xi personally when nobody else from the United States could meet with President Xi. President Xi wanted to meet with him. And you can underestimate the reverence that the Chinese leadership has and has had for generations for Henry Kissinger. Now, part of that is part of the culture. They really revere the elderly, people who have a lot of experience. It reminds me actually of Charlie Munger right now.
Yes,
Warren
exactly.
Buffett.
We were just saying that, yeah.
Where Charlie Munger said, boy, you get a good executive, you keep them there forever. You don't turn them over for every 5 or 6 years. But the Chinese really revere that. But also, if you think from China's point of view, imagine where China was when he went there first and where it is now. And would it have gotten there? I'm not sure it would have gotten as far or as fast without Henry Kissinger and Richard Nixon, because it was Richard Nixon's idea.
Yes.
Henry Kissinger implemented it, but it was actually Richard Nixon's strategy.
David, thank you so much for joining us. David Weston, he is the host of Wall Street Week, which is one of my favorite brands ever on Wall Street. Wall Street Week airing both on radio and television with his thoughts, his perspectives on the extraordinary life of Henry Kissinger, passed away at the age of 100. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Thank you, Paul. Shares of Ford right now, they are lower. They're down more than 1%. And this is after the automaker restored its financial guidance for the year. Bloomberg's Kriti Gupta says it's not exactly good news.
Feels like the reinstating of guidance provides some clarity to the investor audience. Basically, they're saying that the profits are going to come in lower than they earlier projected, all of it tied to the labor cost from the new UAW contract that has been set in. But the numbers here are now, the range goes from 10 billion to about 10.5 billion. That is down, by the way, from about 11 to 12 billion before they had to suspend their guidance.
Now, Kriti mentioned the labor costs from its new contract with United Auto Workers. Ford says those costs will rise by $8.8 billion over the nearly 5-year contract. But Ford CFO John Lawler told Bloomberg earlier he's hoping to limit passing on the buck to the consumer.
You have to think about pricing differently in our industry because all segments aren't the same. There's different pricing power across the segments. That's why we feel that what we did in segmenting the business and having the transparency around that is important. If you look at the commercial business in Pro, we believe there's still pent-up demand and pricing power there. However, in Blue, in the more of the retail consumer segment, you're going to see prices come down.
Now, we're not done talking about the union just yet. The UAW says it's now looking to extend its influence after it reached new contracts with General Motors, Ford, and Stellantis. It's launching organization campaigns at Tesla and a dozen other automakers that do business in the U.S. And it sees 150,000 potential union members between those companies. General Motors and Stellantis right now are higher. Those are the company stories we're following this hour. I'm Lisa Mateo, and this is Bloomberg.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. We had a rally that put the S&P 500 less than 5% away from its all-time high. struggling to gain traction this morning. We did have some Fed-friendly inflation data this morning. Now, despite that, Treasury yields are rising. We paired some of the earlier gains after OPEC Plus agreed to production cuts. The Dow component Chevron, though, that's up 1.3%. Energy, one of the best performing industry groups in the S&P 500. After that, we have right now checking NYMEX crude up 1.75%, 79.23 a barrel. Salesforce shares, they're up 7%. The application software company's third quarter results and profit forecasts both beat estimates. Right now, the S&P 500 up only 4 points, a rise of 0.1%. We're at 45.55 in the index. The Dow Jones Industrial Average, 270 points higher. That's up 0.75%. NASDAQ 100 right now, down 0.3%, 45 points lower. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Molly and Paul.
All right, John Tucker, thank you so much. We appreciate it. Molly Smith, the Molly Smith of Bloomberg News, sitting in for Matt Miller. We have no idea where he is, driving out probably his Tesla Cybertruck. I don't know what he's doing here. But Molly Smith joins us here in our Bloomberg Interactive Broker Studio.
The Molly Smith, apparently, been upgraded today.
Exactly. It's just John Tucker, but it's the Molly Smith. We're also streaming on YouTube, so head over to youtube.com. And Bloomberg is now in your dashboard. How? With Apple CarPlay and Android Auto. It gives you access to every Bloomberg podcast, live audio feeds from Bloomberg Radio, print stories from Bloomberg News in audio form, and the latest headlines at the click of a button with Bloomberg News Now. How do you get it? Well, first of all, it's free. I like that. It's free with the latest version of the Bloomberg Business app. That's the Bloomberg Business app. Get it on your phone in the Apple Store or on Google Play. Just download the app, connect your phone to your car, and get started. And it's all presented by our sponsor, Interactive Brokers. I don't know if the Cybertruck thingamajiggy's got Apple Play. We'll check in with our next guest, Dan Ives. He knows everything about this stuff. Dan Ives is a managing director, senior equity analyst, Wedbush Securities, and a Penn State rabid fan of note there. All right, Dan, I'm seeing the video of the Cybertruck. I just don't get it, dude. I don't see it. It's not a truck, man. I can't throw a bale of hay in the back of the truck.
More importantly, why are you carrying bales of hay?
Well, because I'm a rancher, maybe. I'm gonna get a wrench, you know. I'm thinking about that. I watch Yellowstone. So, Dan, talk to us about this Cybertruck. What's it mean for Tesla?
Look, this is important. I call it a historical event for Tesla and Musk in terms of this new category, 4 years in the making. I mean, you got 2 million reservations. Even if 40% of those convert based on our estimates, 800,000. I mean, this is going to be a new growth vehicle, obviously on the edge, the Mad Max design. But I think this is going to be successful. And I think, look, people like Miller, they're going to be driving this around New York.
Wow, Matt, I hope you're listening in to hear that one.
Well, he's not going to get his wife to sign off on this. He's got the Challenger with the Scat Pack. That's enough.
Well, we're gonna have to see if it can strap in a baby carriage in the back. So that would be the most important for him right now. Dan, tell us what you think this is going to be successful. Tell us a little bit about some of the projections you've run and just how break down the numbers for us in terms of how this is going to play out for Tesla.
Look, the important thing today is about pricing, because that's really the unknown. We think pricing is probably sweet spot 60 to 70K, and that's important. You'll also get tax credit there. At that level, at scale, 2 to 250,000 per year as we get into 2025 in terms of units. Now, coming out, this is going to be complex to build. It's all going to be built out of Austin. That's where the launch will be today. But this is important because it goes back to, something we've talked about on the show a lot is the refresh. It's just more categories. It's part of the halo effect. Contrast that GM Ford pulling back a little on EVs, yet Tesla Musk actually doubled down.
So I think Elon himself has even said, Dan, that this kind of thing is, I guess in his opinion, kind of a profitability disaster, production disaster. It's so hard. Can you make any money on this truck? Is there any profitability in this truck?
Yeah, Paul, first 12 to 18 months, no. I mean, they'll essentially lose money. It'll be cash flow negative. But as you get into 2025, it actually could be pretty significant in terms of the accretive level as it all plays out at scale. Now, at 50,000 units, we think that's probably max 2024, probably about 40,000 in terms of what they'll ultimately deliver. But this is all about the next 2 to 3 years. It's giving them their other growth vehicle And I think this is really the start of just the next phase of the Tesla growth story. This is 4 years in the making in terms of today's launch.
Dan, tell us a little bit more about the competition that the Cybertruck is going to be stacked up against. I think, the Ford, F-Series, particularly the F-150, right? That's the best-selling truck in America, isn't it?
I drove that F-150 Lightning.
Yeah, so the electric one there, sure. And then you've got the Ram, the Chevy Silverado. I mean, how's the Cybertruck, you think, going to stack up against those?
Well, F-150, I mean, that's the target on the back. I mean, they're really trying to go for some sort of churn there. You look what Rivian's done, the success. Now, they've had a lot of difficulty in terms of building it out, but in terms of success from a demand perspective, you look at that opportunity, you look at what we're seeing coming out of GM. Look, this is really creating a new category, but it's part of the halo effect. And I think the difference today, 4 or 5 years ago, everyone kind of viewed it as, okay, Tesla, they're not going to be successful. Today, there's not an auto manufacturer executive around the world that won't be watching the event, because you can no longer just say that it's not going to be relevant. It's actually the opposite in terms of they're leading in terms of really innovation technology.
Hey, Dan, when you speak with the folks at Tesla, and you also speak to the other auto manufacturers, what's the thinking today about maybe the ultimate demand curve for EVs over the next 5 years? It seems to have lost a little enthusiasm out there.
Yeah, I mean, look, I think it's no secret you've definitely seen a moderation. But I think the view among many in the industry is, okay, let's say it doesn't go to 50 to 60% penetration. Let's say it goes to 30, 40% penetration next 5-6 years. That's $2 trillion in terms of the amount of ultimately opportunity out there in terms of electric vehicles. So you continue to see aggressive push toward this. I think the big thing is price discovery. You're not going to have 80, 90,000. You need to be in that sweet spot, 40 to 50K. And that's what we're seeing in terms of that price war that's played out, well known in terms of what's happening in China. It's really price discovery. But finally, we're seeing some sort of supply-demand equilibrium. But I don't really see a pulling back. GM Ford, that's essentially UAW that really forced that hand to pull back a little in terms of some spending.
So speaking of the economics of this is a tough time right now to be buying a car and to be, persuading consumers that this is the time to be getting really excited about that when you have auto loan rates as high as they are. I mean, certainly the holidays, big time to roll out a lot of incentives on price and maybe rates if you can. But what exactly is the pitch right now to, financially, that people might be getting excited about this?
Well, the big thing, too, is tax credits. And I'd expect some more tax credit incentives as we go into 24, from Biden administration, because that's a key point. If you go back, historically, let's call it 70, 80,000. Now you're getting some of these EV vehicles, especially for Tesla, Y, and others, 35, 40,000 when it's all said and done. Here, you're going to have incentives, but no doubt, because what we've seen from a rising rate environment, that's been a huge headwind that does start to reverse in 24. That's why the comps get easier in 24. And I do believe we are still going into what I view as a golden age for electric vehicles. And I think that's why it's important today for this event pricing. It's really going to be a flex to muscles event for Musk and Tesla.
Dan, the stock Tesla's up 97% year to date, clawing its way back to its all-time high that had a couple years ago. You've been, I would argue, one of the biggest bulls on Tesla, on EVs in general, and then by extension, Elon Musk. How frustrating is it for you to see yesterday, for example, another situation where Elon Musk really comes into the news in not necessarily a good way on a company that's not even related to Tesla? How do you and investors kind of deal with the Elon Musk risk factor?
Yeah, it's part of that spider web. I mean, even what we saw over X, and obviously, he went to Israel in terms of the trip. And then if you look at the interview yesterday, I mean, clearly there's going to be no champagne dinner between Musk and Iger anytime soon. I do think relative to Tesla, it is a bit contained relative to any sort of brand deterioration. But as we talked about, I mean, Musk is Musk. He's going to go to the beat of a different drum. That's why you have the loyalists but then of course the haters as well. And that's just, I think it's more accepted to some extent from a Tesla perspective, but no doubt it's a fine balance between from a brand issue or any sort of deterioration. Right now it's contained, but it's not what you want to see yesterday, ultimately, as a Tesla holder.
All right, Dan, thanks so much for joining us. As always, really appreciate it. Dan Ives, Managing Director, Senior Equity Analyst at Wedbush Securities, a rabid Penn State Nittany Lion fan. We're waiting to see which bowl game Penn State will go to. They have a ranking of number 10 nationally, pretty solid there. So we'll see where they play on New Year's Day. Dan Ives talking to us about Tesla. Again, Tesla's off about just 1/4% today, but again, up 98% year to date. So again, the market's really putting a lot of value in the growth story at Tesla, as it has for many, many years. And then, as Dan was suggesting, maybe the next driver of that growth will be the Cybertruck. Certainly gets high marks for just looking cool and looking different. We'll see how it does with the consumers. Right now, let's head down to Washington, D.C. We'll get world and national news with Amy Morris.
All right, thank you, Paul. Lawmakers are considering an aid package for Israel. Senate Majority Leader Chuck Schumer, meanwhile, issuing a warning. Bloomberg's Nancy Lyons with that story.
Senator Schumer, who is the highest-ranking Jewish elected official in the country, spent 45 minutes on the Senate floor decrying the rise in anti-Semitism at a level not seen in decades.
The normalization and exacerbation of this rise in hate is the danger many Jewish people fear most.
The Anti-Defamation League says anti-Semitic incidents have nearly quadrupled since the onset of the Israel-Hamas war. Schumer says it's time for a clear-throated denouncement of the hate. In Washington, Nancy Lyons, Bloomberg Radio.
Israel and Hamas agreed to lengthen their truce for another day, allowing for the release of more hostages held by the militant group in Gaza. We get more with Bloomberg's Lisa Fleischer.
The truce was extended basically last minute, like 5 minutes before the 7 a.m. deadline. And from what we understand, Israel and Hamas through Egypt, the U.S. and Qatar, were talking way into the night to figure out how to get this done. And the U.S. is putting immense pressure on Israel to keep the talks going, while Egypt and Qatar are pressuring Hamas to do the same.
The announcement comes as leaders from around the world are stepping up their efforts to keep the situation from escalating, and as Secretary of State Antony Blinken makes another visit to Israel. Elon Musk says ad boycotts on his social media platform X could kill it. He spoke at the Deal Book conference yesterday. Bloomberg's Aisha Counts has more.
He said it in pretty dire terms, but he also had some negative things to say towards the advertisers, and he sort of said, we don't really care if you leave. So it's sort of a mixed message, but definitely a strong statement from him about the health of the business if these advertisers don't come back.
Bloomberg's Aisha Counts tells us Musk says if the company fails, it will be the advertisers' fault. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Among the headlines this morning, OPEC Plus agreeing to make 1 million barrel a day of additional oil supply cuts. So that news pushed oil prices higher, and Dow component Chevron up 0.9%. This November to Remember rally has the S&P 500 about 5% away from its all-time high. Can it reclaim the peak? Well, Michael Shaul of Market Field Asset Management says the stock rally isn't really supported by the current scenarios.
Either the economy is still okay and strengthening, in which case I don't think the 10-year is staying at 425, or we're in this pre-recession period and we're going to have a much, much weaker economy in 6 months' time, which apparently people want. And that's not really compatible with the S&P going to 5,000.
We did have data this morning. It kind of bolstered bets. The Federal Reserve is done with its hiking cycle, but counterintuitively, Treasury yields, they are higher right now. The 10-year, 7 basis points higher at 433. The 2-year, up 6 basis points. That's at 471. And then some individual share news. AbbVie will acquire all outstanding shares of Immunogen for $31.26 a share in cash. Those shares are up 81%. S&P 500 down 2 right now, 45.47. The Dow up 285 points. The NASDAQ 100, 113 points lower. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Molly and Paul.
All right, John Tucker, thank you so much. We appreciate that. Molly Smith, Paul Sweeney live here in our Bloomberg Interactive Broker studio, streaming live on YouTube. I'm looking at the Bankrate.com U.S. home mortgage 30-year fixed national average, 7.66%. Man, is that high relative to where we've been over the last 15 years. But it's down from 8.09% back on October 25th. So maybe the trend is our friend here. Let's talk about what that means for the U.S. housing market. We'd like to do that with Lisa Sturdivant, Chief Economist at Bright MLS. So, Lisa, I'm not sure. I guess the story for the residential real estate market is not a lot is happening because sellers don't want to sell their homes and have to go into something new at a much higher mortgage rate. Give us a sense of what's the landscape looking like right now with rates coming down slightly.
Yeah, you're absolutely right. We've seen sellers sort of sitting tight on those sub 3% mortgages, really reticent to trade in for a much higher rate. So we've had a very slow housing market. The fourth quarter here of 2023 likely to be the slowest in the last 2 decades here for fourth quarter activity. And I think as we see mortgage rates begin to come down further in 2024, I think we're actually going to start to see some of that inventory loosen up as homeowners sort of make peace with the fact that they're going to have to give up their really low rate because, you know, life happens.
And as you start to see that supply coming up, Lisa, tell us about the demand picture. Is there enough out there to meet that rise in supply, and what does that mean for prices?
Yeah, it's a great question. And we often think about mortgage rates falling, bringing more demand into the market. And it is very clear that there is unmet demand still out there. If you look at folks in their 30s right now, if people in their 30s had the same homeownership rates as those of us did 20 years ago, we'd have nearly 750,000 more homeowners in the market. So there is pent-up demand. And as rates come down, we'll see both supply and demand increase as we head into the spring of 2024. That's actually going to keep prices pretty stable in most markets.
I'm looking for what I'm calling a clearing rate, where the mortgage rate where sellers are like, all right, I'm ready to go now. And I don't know if that's 7%, 6%, 5%. When you talk to the real estate folks out there, what are you hearing?
Yeah, you know, I don't think it has to be as low as we might think. I think it has to just be lower than it is now. And I think people are resetting their expectations even as we speak. And I think about 2024 as a life happens market, right? People who have not been moving are going to feel like they have to because of a family change or a job change. And they're going to be able to do that if, let's say, rates hit 6.5%. I feel like we're going to see more and more sellers sort of making peace with that rate and listing their homes for sale.
You know, Paul and I were just looking at each other before when you were telling us about these people in their 30s who would love to buy a home, as I am almost 30 and in that camp myself. And we've been talking a lot about my home buying journey and what I've discovered, Lisa, at least in trying to buy in the Upper East Side of New York City, which of course is a microcosm in and of itself, is that, you know, to be a cash buyer in this market, and what I'm talking is at the, quote, low end of the market, which is around $1 million for one bedroom, to be a cash buyer in that market is basically at this point just a prerequisite. You know, it doesn't get you really an advantage because there aren't really financed buyers out there. If you zoom out of the Upper East Side, are you seeing that in other markets across the country too?
Yeah, I think you have a real big challenge there. Right,
yes, thank you so much. It's been a joy.
But I do think what you're seeing is playing out in other markets. The share of cash sales is as high as it's been in most markets. First-time buyers who are having to go out and get financing are finding that they're competing against those cash buyers. And it's really, really hard. In our market here in the East Coast, we're seeing that first-time buyers are having to put an offer on an average of 3 homes before they're successful. And so it does create a lot of challenges for those who aren't bringing cash to the table.
And you're in Virginia right now? Is that right?
Yeah, I'm located in Maryland, and in our market, we're really looking at New Jersey down to Virginia. We're seeing very common patterns of increases in cash buyers in the market.
Well, that's the thing that I find really difficult to speak about housing at a national level because there isn't really a such thing as the U.S. housing market, right? Like it's more of a, city by city, zip code by zip code kind of story. I mean, that's at least how I would think of it. Is that what you would say as well?
Sure, 100%. And we're hearing all sorts of forecasts about what the national home price is going to be in 2024. But as you rightly point out, it really is where you are located. And for most of the country, we're still seeing room for prices to rise in 2024. Some of the highest cost markets on the West Coast are where there's more opportunities for prices to come down. But overall, affordability is going to continue to be a really big challenge in 2024.
So if I walk into my bank, my mortgage broker, and I'm going to put 20 or 30% down on a house, can I even get a mortgage today?
I think so, right? And so I think we're seeing that actually as rates have begun to tick down here over the last few weeks, we've seen mortgage applications actually increase. Okay. We're seeing a lot of opportunistic buyers out there, folks who are watching those rates and maybe sort of waiting to jump when they see rates come down a little bit, which actually might mean we might have a surprising surge in home buying over the holiday season if we see rates come down even more over the next few weeks.
And typically this is more of a slower time in the year for home sales, isn't that right?
Yeah, no, absolutely. People are sort of thinking about the holidays. It's really cold outside. And we saw this last year where the market really sort of ground to a halt when rates hit 7%. If you remember, we hit 7% last year. We thought that was high. So I expect that, in general, folks tend to slow down their home search during the holidays, but may come roaring back in January.
All right. So real quick, what's the hot market? Is it still just South Florida? Is that still the place that's just the hottest?
Yes, Florida certainly has been on fire. I do think there's a potential for some price declines in Florida. Miami is one of the markets where we've identified more new construction coming online, very fast price growth. It's possible then that home prices are going to come down in that market. But I think the Southeast certainly continues to be a really strong market. And the Midwest is frankly where affordability is most positive and where home prices are expected to continue to rise in 2024.
All right, very good. Lisa, thanks so much for joining us. Lisa Sturdivant, Chief Economist at Bright MLS. So at least was saying maybe 3 offers for one deal to get accepted. Has that kind of been your experience?
Yeah, I've had 2 places fall through already, and both of them being, at very close to the contract signing, so far along. And the thing I've learned in New York is that being told that your offer has been accepted means squat. Until a contract has been signed or money has been exchanged, you've got nothing.
When are you signing a contract for this place?
Hypothetically tomorrow. Stay tuned. I'll be back tomorrow. We'll see.
Okay, we'll see. All right.
I'll let you guys know.
But all the e-signing, it should be easy. I mean, I just remember just clicking. You don't even sign anything anymore for the
Really?
closing.
There is no pen to paper?
No, it's all e-signing.
Oh, that's
so
a
I don't know.
bummer.
We'll see how that goes. Maybe on your big Upper East Side pad, that might be different. We'll have to see. We'll have more coming up. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Good morning. Elon Musk is all over the headlines for, let's say, his choice words to advertisers who pulled their marketing from the X platform after he endorsed an anti-Semitic post. Now, it happened during a conference sponsored by the New York Times. The intention was for Musk to apologize for his post, which he did. Bloomberg's Ed Ludlow has some inside info.
The idea, and what I'm hearing from people inside X, the platform and company formerly known as Twitter, is that this is Elon Musk putting the principles of the company above money, above profits. And you will note the post that X's CEO Linda Yaccarino made after Musk's appearance, saying, and indeed calling it, this was an apology and set out what X really feels about the situation. And again, a reiteration from Musk, he is in no way anti-Semitic.
Now, while Musk fights to get advertisers back on his X platform, Facebook parent Meta Platforms, well, it gets ready to launch Threads in Europe. Sources are telling the Wall Street Journal it could happen as soon as next month. Now, that launch would be the social media platform's largest market expansion since its debut in July. Right now, Meta shares are down about 2%. Meanwhile, Elon Musk has other things to be focused on. Today is that long-anticipated release of Tesla's Cybertruck. Yes, after 2 years of delays and production snags, Musk will deliver that first vehicle at the company's Austin headquarters in Texas at 2 p.m. local time. The company is also expected to finally reveal some details about its price, configurations, and battery range. Now, the Cybertruck, that is Tesla's first entry into the highly competitive pickup market in the U.S. Right now, Tesla shares, they're down about 1%. Those are the company stories we're following this hour. I'm Lisa Mateo, and this is Bloomberg.